Okay, so before we start, I want us to first of all know the examination structure. Okay, how the weighting of the syllabus, how each question, how the questions will be set, and the marks that will be allocated to them. So the question one will always be the consolidated financial statements, which under corporate reporting, we have 5 major issues to look at. We have issues with the step acquisition. We have issues with the disposal of a subsidiary. We have issues with complex group structures. And we also have issues with consolidated financial statement of cash flow. And we also have the accounting for foreign subsidiary. They will actually pick one of these complex issues and then set 20 marks question on it. So the question can be on step acquisition, it can be on disposal, it can be on cash flow, it can be on complex group structures, it can be on statement of cash flow, and it can also be on a foreign subsidiary. So the selection of the questions has covered all of these 5 issues. Okay, so it is not likely that they will ask you to prepare statement of profit or loss and at the same time statement of financial position, because that is going to take a lot of your time. If that will happen, then they will reduce the footnote for you. They will reduce the footnote for you. So mostly they will give you a question on statement of financial position. They will give you a question on statement of profit or loss. They are here to ask students to prepare the consolidated statement of changes in equity. And they are also here to talk about issues of cash flow. Okay, so what we have to know is that the consolidated statement of consolidated financial statements what we have to know is that consolidation in corporate reporting are going to be having 5 major issues. The first one is step acquisition. A step acquisition is a situation where control is being achieved in stages. So we have from control to control and from non-control to control. We can have a situation where the parent will first want to see whether the company is profitable. They will buy 10%. They will buy 10%. So they after buying the 10%, they see that okay, the company has a future prospect. They will say they want to add additional 25. This additional 35, this additional 25 will now give them 35, which is going to be giving them significant influence after this date. But this will be accounted as mere investment in accordance with financial instruments. So whenever the company acquires less than 20% of the equity shares of the company, that particular investment will be accounted for as a financial asset, where the company will be using the classification as true profit or loss or true other comprehensive income. But if the percentage holding over here is equity shares, you are buying the shares to become part of the owners. Preference shareholders are not owners of a company. So if the company is buying a preference share of another company, that is not going to give them ownership because preference shareholders are not owners of the company. So the classification that we are talking about over here will be the equity shares because the equity shareholders are the owners of the company. So in the exam, they can say that the company purchased equity shares in addition to preference shares. Preference shares does not give ownership. Forget about the preference shares and now look at the percentage of the equity shares that a company is having in the other company. Okay, so the company can later say, okay, we want to buy additional 25%. This 25 will now give them 60%. So this 60 will now give them a control. So you start consolidating from the time control is achieved. So you ask yourself, when was the day that the company acquired or the company obtained control over the other company? Consolidation will start from the date of control. This is from non-control. This is from non-control to control. From non-control to control is a situation where the company will not be having control first, but acquisition of additional shares is now giving them control. That is what we call the from non-control to control. But we also have another one where we call from control to control. From control to control is a company or the parent is already having control over the subsidiary. So maybe the parent is having 60% and they decide to acquire additional 10%. So if they're having 60%, it means that NCI will be 40%. So they decide to buy 10%. They are buying 10% from the NCI. So NCI will now be having 30%. That is what we call from control to control. So they can examine you on a step acquisition. Both can be statement of financial position. It can also be the statement of profit or loss. Last sitting was statement of profit or loss. Okay, they can still bring a statement of financial position question on step acquisition. What are the issues there you have to look at under the step acquisition? The step acquisition, you have to ask yourself, is it from non-control to control? Or is from control to control? From non-control to control is a situation where the parent will be buying maybe 10%, then the next acquisition will give them control. Maybe they will decide to buy 45% in addition to the 10%. They will now be having 55%. So it is from the date of additional shares that consolidation will start. How do you account for the previous investment? We look at that when we are taking question. I don't want to take your time. I just want to be very brief with the introduction of the 5 major issues. Then we move on. So it can be from step acquisition. It can also be a situation where we call the disposal scenario, okay, where the company acquire a subsidiary. The subsidiary is not doing well. So they want to dispose of the subsidiary. So the disposal is in 2 ways. The company can have 70% and they will sell 40%, remaining 30%. The 30% is now giving them, giving them significant influence. Okay, it's now giving them a significant influence. So you have 70, you are now selling 40. It means that you have 30. The 30 will now lead to what? Loss of control. So the parent is not going to be the parent of the company again. They don't have more than 50% now. They have less than 50. So they have lost control. If control is lost, the company has to calculate gain on disposal. Gain on disposal. Okay. It's just like you have a provision shop that you are the sole owner of the provision shop. So you are the person having 100%. So you are the sole owner. It means that you have 100% ownership. Now you have decided to sell 80% to the person. It means that the shop is no longer your own. The shop now belongs to the person that you are selling the 80% to. So you have sold it and you have to calculate again on it because the shop is no longer your shop. That is something that happens to the control to non-control. The company can still have 70% and they will decide to sell 10%. This 10%, they will still be having 60%, which is what? A sign of what? Control. In this case, the company will not calculate a gain on the disposal because you are still the owner of the company. You are not selling the shop. The shop is 100%. You are the sole owner of the shop. You have decided to sell only 20% of it. Still, you are just selling portion of it, but still you are the majority owner of the shop. So the shop still belongs to you in terms of what? The holding. You are having 80, someone is having 20. So you are not selling the shop entirely. So you are going to, please check your connection. It might be your connection because I hope that everyone can hear me. Please, can you hear me?
I hear.
Okay.
Yes.
Continue. Check your connection. Check your connection. So that is it. So you first have to look at it. Is the disposal leading to a loss of control? Is that if the parent sell the portion of the shares, the remaining holding, is it less than 50%? If it is less than 50%, it means that the company has disposed of the investment entirely. So you have to calculate a gain on the disposal. But if the remaining interest or the remaining percentage of the equity share is more than 50, then there is no sell. Then you just assume that the parent has sold what? This particular one to the what? To NCI. The transaction will be between the parent and the NCI. How do we go about it? we are going to be looking at that now, because we are not here to solve questions. I'm not here to worry you with the complications. I just want to tell you some basics that you can use to what? To get some at least 10 or more marks in consolidation. How do you get the marks? You don't have to do everything. You don't have to do everything. Some of the footnotes are not for you. You don't have to do everything. So you just have to try everything possible to get maybe at least half of the mark. Okay, so we are going to solve some questions anyway. If you're not able to solve some of them, we discuss the footnotes and move on. But I'm not here to bother you with how you account for the cell between the NC and the parent. Okay, that is not any big deal, but we take a question. If you look at it, then we go about that particular one. We can also have issues with complex groups. Okay, a complex group is a situation where A has 70% in B and B has 60% in what? In C. You can see that A owns B, but B owns C. Indirectly, B is a subsidiary of A and C is a subsidiary of what? Of B. Since B is owned by a different person, indirectly, C is also owned by that particular person, because A is the owner of B. So if B is now buying C, it means that the B is buying the C on behalf of what? The A, because A is the what? Is the ultimate what? Parent. So it means that if A, if C makes a profit of 1,000 Ghana cedis, B will take 60% of it. This 60% over here will be shared among what? 70%. The profit that B will be taking, it will be shared among the owners of what? The B. And that owners, A is having 70 and NCI is having 30. So this particular profit of 60% over here, the parent will be taking 70% of it. NCI will be taking 30% of it. So indirectly, A will be having 70% of the 60% that B is having in C. So that particular control that A is having over C, we call it what? Indirect interest. Because whatever is going to happen in C, B will have 60% of it. And that particular thing, A will now have 70% of it, because B is owned by A. So anything that is happening in B, A will be having 70% of it. So if this person is making a profit of 1,000 and B is taking 60%, after taking this particular 60%, which is 600, this 600 that will be given to B will be shared among the owners of A, among the owners of B, which A is a 70% owner and the remaining people are 30% owner. So this particular 600 will be shared 70% for A, 30% for the NCI. So indirectly, we say that whatever is going to happen in the subsidiary, the parent will be having its share that they have in the subsidiary itself. So we say that is a complex group structure. So what we do is that B cannot prepare a financial statement on itself and consolidate what? C, because B itself is a partially owned subsidiary of A. So A will now prepare a consolidated financial statement and consolidate the two. Instead of being consolidating C, B cannot, because B is what? Is a subsidiary of another company. And that is one of the exemptions of a company having a control, but they will not be allowed to prepare a financial statement. The parent itself is a wholly owned or partially owned subsidiary of another what? Parent. Of another parent. So that is the issue over here, which we call the complex group structure. So whatever is going to be happening in C, A will be having 60% of it. B will be having 60% of the share, and that particular 60% will be shared amongst the owners of A, the owners of B rather, and A is having 70, NCA is having 30. So what do? We find the indirect interest. The indirect interest will be the 60% of the holding over here multiplied by what? The A is what? 70%. So 60 times this one, and that will give you a figure what you have to know is that if you are finding indirect control, which is 60% times the 70%, okay, you might be getting 42%, which is less than 50%. Don't say that this is not a control. No. What we use as a measure of control is the percentage holding that the main subsidiary is having in the sub-subsidiary. B is having 60% of what? C. It means that B owns what? C. B is having control over C. So since B is having control over C, it means that indirectly A has control over what? Over the C. But the indirect interest, we are just looking for whatever profit that will be made in the sub-subsidiary. What will be the parent portion of it? That is the indirect interest. That is the indirect interest that we are looking at. What will be the parent share of the what? The profit in the sub-subsidiary. The parent share will be the share of the main subsidiary. So the main subsidiary will have their share from that particular company, and the parent will now have a share of the profit from the sub-subsidiary. So the indirect interest, we are only looking for the parent share of the profit in the sub-subsidiary, not a measure of control. Because the main subsidiary, which is the B, already have control over C, which is 60%. But we are only doing the consolidation on behalf of what? Of B, because B itself is a subsidiary of another company. So you cannot consolidate. All right. So this, we have what we call the vertical group structure. And the vertical group structure is what I have demonstrated. The vertical group structure, the parent itself, which is the A, is not going to be having, so we have no direct interest in the what? In the sub-subsidiary. So the parent itself is not going to have any direct interest. You can see that A is not buying any shares in C. That is what we call the vertical group. So the parent will only have control or will only have interest through the what? Through the subsidiary. The parent is not going to be having any interest there. There can be a situation where the A itself, will be having 14% in C before the B will be having their 60%. In this particular case, you can see that A itself is having indirect what percentage holding in the C before the subsidiary is also having 60 over here. So how do we find the indirect, or how do we find the total share of the profit in the sub-subsidiary? You have the parent share of the subsidiary share, which will be 60%, now plus the parent own share. Whatever profit that they are going to be making, the parent will be having 14%. But whatever profit that they will be making, the parent itself, which is the B, will have 60%. And this 60% will now be shared among the owners of the B, which is the A and the NCI. So this is how we find the indirect control. So we have the vertical group structure and also the D shape. The D shape, which is what we call the mixed group, structure. How do we go about it? We are going to look at that. How do we go about it? We are going to look at that. How do we account for the goodwill calculation, the NCA, and all those things in the sub-subsidiary? How do we go about it? We'll look at that shortly. All right. The next one is what we call the cash flow. Okay. The cash flow over here going to be what we call the consolidated cash flow. Okay. The cash flow that we know is cash flow for a single entity, but they are going to ask you the cash flow for a single entity is just the financial reporting issues. In corporate reporting, they will ask you to prepare a cash flow for what? More than one entity. And that's what we call the consolidated what? Cash flow. How do we go about it? The calculation is the same. The preparation of the cash flow is still the same. It's follow the same principle under the what? The cash flow for a single entity. But what we do is that under the operating activities for the single entity, we use profit before tax. But over here, we use profit before tax. Okay, we use profit before tax, but it should be including the share of associate profits. So profit after the share of the associate profit, that is what we use. Then what do? You have to know that the cash flow that they are asking you to prepare is the same as the normal cash book that you prepare. The cash flow that they are asking you to prepare is just like the normal cash flow or the normal cash book that you prepare in the office. But the normal cash book, the way you prepare it, that you just arrange the items anyhow. If the company issue capital or if the company introduce a new capital in form of cash, you just say debit side. You just say capital, 10,000. Okay, if the company sell on cash basis, you just say cash sales. Then you say 15,000. If the company paid maybe creditor, you say purchases, 20,000, something like this. You see that you just put the items together, you don't group them. But for the cash flow statement, the only difference is that we group the items in the cash book under what? Important headings. So we have the operating activities where those day-to-day activities will be classified. So the day-to-day activities, the operating activities, we are going to be having our cash sales, our cash purchases, our amount that we pay to creditors, and the cash that we receive from what? Customers. Those are the things that will come there. The expenses that we paid in cash, they will come under the operating activities. So the operating activities is just like the day-to-day activities of the company, issues relating to the day-to-day activities of the company. I'm saying that the cash flow statement is just like the cash book, the preparation of the cash book. The only difference is that you are going to be classifying the items under important what? Headings. That is the only difference. So it's only cash items. If you are preparing cash book, you are not going to be sending credit sales there. You are not going to be sending depreciation there. You're not going to be sending interest always there. But if you come to the profit or loss statement, those non-cash items will be taken there. So the cash flow statement is just like the normal cash book. But this one, we group the items. We have the operating activities where the cash received from customers, the cash paid to creditors, the salary that we paid for the year, the electricity and those things that we paid, water bill that we paid for the year will all come under the operating activities. Then you come to investing activities. Investing activities has to do with issues that are relating to the expansion of the company. So acquisition of shares in another company is a form of the company expanding its operations. So acquisition of shares, acquisition of subsidiary will come there, acquisition of non-current assets, disposal of non-current assets will all come under the investing activities. If you come to the financing activities, there are issues relating to what? Getting funds for the what? Activities of the company. Where do you get money before financing the operations of the company? You can take money from loans. It can also be you issue shares, existing shares. Maybe you have purchased some of the shares back. You have redeemed your debts. You have paid interest. You have paid dividend to the owners. All those things will be under the financing activities. But on the face of it, don't panic. The cash flow statements is just the same as what the cash book preparation that you do, but just that you don't classify the items under the cash book. You put all of them together. The cash flow statements, we separate them under individual or under important what? Headings. We have two methods of preparing the cash flow statements. We have the direct method. The direct method, we do the direct method like the normal cash flow. So what was the total cash that you received for the year? You take your cash receipts, you subtract your cash that you pay to your creditors, your cash expenses, what are the PPEs or the non-current assets that you purchased during the year. You take the amount, what are the cash that we receive from sale of what? The non-current items. This is the amount. Did we issue any shares during the year? What is the amount? We add it. Did we pay any loan during the year? What is the amount? We add it, and we add the opening balance from the cash flow for the year, and we subtract. So the direct method is just a straightforward. What is the cash received for the year? We take it. What is the cash paid? What is the total cash received? What is the total cash paid? That is all. We also have the indirect method. The indirect method is where we use the profit or loss method. We start with profit. You have to know that profit is not cash. Profit is including some items of what? Cash, and some items of what? Credit, and also some items of non-cash. So how did you get your profit? You have subtracted some non-cash items, and you have also added non-cash items. We are looking for the cash. So we have to go and subtract the non-cash items that were added, and the non-cash items, we add those were subtracted. So that is how we go about it. And we are going to be looking at how we adjust that particular issue. It's not any big deal. We also have issues with a foreign subsidiary. So we also have issues with foreign subsidiary. Okay. For the foreign subsidiary, it's just like a company is in Ghana, but they have what? A subsidiary in Nigeria. You see, at the group level, the two entities will be allowed to prepare their separate financial statements. The Nigerian company will prepare their separate financial statements. The Ghanaian-based company will also prepare its separate financial statements. But at the end of the day, the company will now prepare a one single financial statement, which we call the consolidated financial statement, which is the group accounts. The company will now prepare group accounts. The group account will be prepared in the presentation currency of the parents. If I say presentation currency, I'm talking about the currency in which the financial statement of the parents is being presented. So the financial statement will be prepared. If the company is preparing financial statement in Ghana city, the financial statement or the group account will be prepared in the Ghana city. Now you are having activities of what? A foreign company, a Nigerian company. What do? You have to translate what? The figures for the subsidiary to the parent what? Currency. This is likely to result in a gain or loss. How do we do with the gain? How do we do with the loss? How do you go about the translation? What you have to know is that even if you cannot adjust or you cannot calculate the gain or loss on the translation, know that profit or loss items are for the year. A lot of things happen during the year. So what we do is that there might be a lot of what? Exchange rate fluctuations during the year. So what we do is that we use average rate for the year to translate what? Profit or loss items. Because during the year, there might be a lot of what? Up and downs in the exchange rate. So we use the average rate. So just take the items of the first subsidiary, then you just what? Translate it using the average rate. The translation, you have to be very careful. Some of them you'll be multiplying, and some of them you'll be what? Dividing to get what? The presentation currency of the parent. You have to be very careful with that one. Some of them you'll be dividing to translate to the presentation currency of the parent. Some of them you'll be multiplying. You have to be very careful. If you don't know how to do, just use simple ratio and proportion. So the question will say that, okay, 1 Ghana cedi is equal to 2 Nigerian naira. So you are trying to translate naira to what? To Ghana cedi. So maybe the revenue was 200,000. So you ask yourself, if 1 cedi is equal to 2 naira, how many cedis will be equal to 200,000 what? Naira. So you can see that you'll be dividing. So you just cross multiply. Then you know how to find the X. Then with this particular, you know that how you are going to be dividing, how you are going to be going about it. So you just use your simple ratio and proportion. If the exchange rate given to you, if 1 cedi is equal to this, then how much will be equal to this? That is all. Then you know whether you'll be dividing or you will be subtracting. What about the statement of financial position items? The statement of financial position items are items as at. They are items as at. So they are at that date, as at the reporting date. Those are the items. So we use the closing rate, or we use the rates at the reporting date. We use the rate at the reporting date, which is the closing rate, So you just translate it like this. Even if you don't know how to calculate the gain on the translation, you can just translate it, put your figures there, go and see whether you can do something about some of the footnotes, because whatever happens, they will be asking you to do both statement of profits and statement of financial position. For the foreign subsidiary, they cannot give you only one statement. They'll always give you two. So just translate the two with your average rate for profit or loss, the closing rate for statement of financial position. Then you go and look at the group structure. How do I put the group structure there? Can I determine goodwill? Can I determine goodwill on acquisition? Can I put the NCA together? can I do something about the parent group retain earnings? You just put those items there and move on. Just put those items there and move on. Okay, there are certain things that you have to know about the foreign subsidiary. What do you have to know? Okay, the net asset is being determined in the what? In the subsidiary currency. Okay, so the net asset is calculated in the subsidiaries or currency, which let me just put it over here, the foreign currency. So you determine the net asset in the foreign currency, which is the subsidiary currency. Your goodwill will also be calculated. Goodwill will also be calculated in the foreign currency before you translate. So I'm going to give you some tips about how to just get the statement of financial position items straightforward. But whatever be the case, you have to calculate again. So if you do this one like this, you'll be having post-acquisition what? Profit. This post-acquisition profit, if you want to calculate the gain on the net assets, then it means that you can translate it using average rate, because profit will be calculated using average rate. But if you don't want to calculate the gain, or you don't want to show the parent share of the gain on the net asset, then you can translate the post-acquisition profit using what? Closing rate. Why? Because this is part of the retained earnings. The retained earnings is a statement of financial position item. So you can use the closing rate and just share among the parent and then the NCR. Okay. The goodwill.
Can you come again?
I should come again.
Yes, please. On the PAP.
Okay. The PAP, I'm saying that if you want to determine the gain on the net asset, because at the end of the day, we determine the gain on the net asset and goodwill. Okay. I'm saying that if you don't want to determine the gain on the net asset, the gain will be shared among the parents and then the NCR. If you don't want to determine the gain over here, then just translate the PAP using closing rates, because the PAP is part of the retained earnings of the subsidiary, and the retained earnings is a statement of financial position item. But if you want to calculate a gain on a net asset, it means that the gain on a profit or loss over here, which you'll be, if you translate with average and closing, there will be a gain, because profit in the statement of profit or loss will be translated using average rate. But in the statement of financial position, it will be translated using closing rates. So there will be a gain or loss in these translations. Okay, if you don't want to determine the gain, which will be included in the net asset, because the profit will be part of the net assets. So if you translate using average rate, it means that the gain on the translation of PAP will be what? Included over here. So if you're preparing statement of financial position, just translate using closing rate and share. And share to the what? To the parent and then the NCI. That is all. If you come to the goodwill, if there's any impairment, the impairment will be determined in the what? In the foreign what? Currency. Just look at the closing goodwill, closing balance for the goodwill. Then use the closing rate, because goodwill will go to what? Statement of what? Financial position. But whatever be the case, if you want to find the gain on the net asset, which will always be calculated, and the gains on the goodwill, we also look at what to do. But the goodwill should always be translated. The goodwill at reporting should always be translated using closing rates. So you take that figure to the statement of financial position as your goodwill. Okay. Sometimes I don't want to bother you. There are a lot of ways of going about this particular issue, but let's see which of them will work for us. Okay. So basically, these are the issues: step acquisition, where control is achieved in stages, or the company already has control, but they want to buy additional shares. How do we account for that particular transaction? It is accounted for as a transaction between the parents and then the NCI. You find a portion that the parent is buying from the NCI, then you know how to go about it. We don't recognize again any difference between the amount that the parent has received and the portion that they have transferred or NCI has been transferred to them will be recognized in other components of equity. We also have the disposal situations. We also have the complex groups. We have the cash flow statement, and we also have the foreign subsidiary. What we have to know is that the examiner likes complex groups, step acquisition. Those are the two things that they like most. If you look at the question, the past questions, those are the two issues that were examined more. than any of them. But whatever be the case, last sitting was step acquisition. We can say that it is not likely, but you have to have knowledge about it. This sitting can be step acquisition or cash flow or foreign subsidiary. They have examined certain issues on foreign subsidiary before, but it's not a question on each one, but they include it in another issue, which is disposal. They have examined disposal. They have examined step acquisition more than 2 times, complex groups more than 3 times. They are here to examine the cash flow and also the foreign subsidiary as a question on each one. But I'm not saying that you should go and focus on cash flow. I'm not saying that you should go and focus on foreign subsidiary. I'm not saying that it is likely that they are going to bring those ones because they have to examine them before the new syllabus. Okay. But you have to focus on complex group structure because they like that particular one more than any of them, the step acquisition and also the cash flow statement. All right. How do you solve console questions in the exam hall? My sister, consolidation means what? Adding the items of 2 entities or 2 or more entities line by line, put their figures together as if they are one entity. If you have a house, if you have 2 houses, your father has 3 houses and they are same family houses, it will be 5 houses because you are part of the family, your father is part of the family. We are consolidating. That is the meaning of the consolidation. So if you are preparing statement of financial position, if you are preparing statement of financial position, it doesn't matter when the acquisition is done. If you sell your company to me on the last reporting date, on that particular date, the company is no longer your own. I'm the owner of the company. So it doesn't matter when the acquisition is done. For statement of financial position, it doesn't matter when acquisition is done. If you sell your motor to me on the last day, on that particular day, the motor is mine, not yours again. So it doesn't matter how the acquisition is done. If you're preparing statement of financial position, take the items, the parent one, the figures given to you, take the PPE, maybe 200, determine the subsidiary, who the subsidiaries are, determine them, then you add their figures. It doesn't matter if the acquisition is done 3 months to the reporting period. No. At the end of the year, the asset belongs to the parents, not the original owners of what? The subsidiary. So if you want to solve the question, go and read the footnotes. Even the financial statement given to you will tell you which of the statement you are asked to prepare. So if it is statement of financial position, the parent will always be the first company. So if you are giving companies A, B, C, the parent will always be the A will always, or the first company will always be the parent. The second will be a subsidiary. The third may be associate or a subsidiary. So just determine the parent is this one. Come and take PPE, take the parent figures, put it in a bracket, all of them one by one. What you have to know is that we don't bring the investment in associates, the investment in the what? In the subsidiaries. At the end of the day, we reconcile them because the investment will cancel the equity shares of what? Of the subsidiary. In the group account, we don't bring the equity items of the subsidiary. The ones at the date of acquisition will be consumed by the investments, and the ones at reporting or during the year will be consumed into the NCI and also the parent group return earnings. So take the parent items, the asset one by one, take them one by one, put your structure there. Then you come and scan through the footnote to see the subsidiary, which is the B. At the reporting date, is the parent still having control over them? If yes, come and add their figures to that one. Then you look at the C. The C is an associate. Associate is not part of the group. You are not having control over the associate, so you can't consolidate them. But if they are also a subsidiary, come and check whether there was any disposal during the year. If there were no disposal, come and add their figures to them. After adding the figures, you first don't go and be tackling the footnotes. No. You don't have all the day. You don't have all the time in the world. Put your structure there because even if you determine that or you deal with the footnote, you will still be adding the figures in the statement of financial position. Why can't you add those figures? If you're not able to go with certain issues, then you will come and what? Adjust the ones that you can adjust. Then you move on. So put the financial statement there, statement of financial position, put it there. Okay. The parent might acquire the subsidiary on July, but the reporting date will be December. You see that from the acquisition to this one, the company continues to operate for 6 months. Okay. This particular 6 month profit now is for the what? Is for the owners of the company. And the owners, the parent is part of the owners, and the remaining owners will be the NCR. So the 6 month profit will now be shared in the proportion of what? The ownership. The parent will be having each share, the NCR, we put them together, they will also be having their share, which we call the post-acquisition profit. How do you determine this? Because you are not having statement of profit or loss to know what the profit is. We look at the net assets. The net assets, what we are talking about as the net assets, is the shareholders fund. Okay, it is the shareholders fund because under ratios, the definition for net asset under ratios is different from the definition for net asset under business valuation and also consolidation. Okay, consolidation is more like the business valuation because the person who is selling has to value the business at the date of what? At the date of sale before they sell. Okay, so you have to look at the net asset. The net asset is the shareholders fund. Under the consolidation, we assume that the equity shares is going to be what? Fixed. Equity shares are going to be fixed from the date of acquisition to the date of what? Reporting. Because the parent is having 70%. That time the equity shares were 10,000 shares. Okay. If at reporting now the share is now 15,000, you can see that the control, the holding will still not be 70%. But we want the parent to maintain what? A constant holding throughout the year. So whatever be the case, it should be 70%. Therefore, the equity capital should be the same for every year. There will not be any additional issue of equity shares. So they will give you equity capital at the reporting date. It is the same as the equity capital at acquisition. There should not be any movement in the equity shares. But the only movement that is allowed is in the other reserves. That will be maybe revaluation surplus during the year, other gain, maybe gain on remeasurement of employees' benefits. It can also be maybe other components of equity as a result of share options and all those things. So those are the only movement that will be allowed. Movement also in the retained earnings or the income surplus is also allowed. And the movement in the retained earnings, okay, the movement in the retained earnings is the movement that is relating to as the post-acquisition profit. Because the only thing that can increase retained earnings is the profit for the year. So we look at the retained earnings at acquisition. What is the retained earnings at reporting? The only movement over there will be the profit that the company made during the post-acquisition period. Because at acquisition, this is the figure. As reported, this is the figure. So we prepare our net asset table to know our post-acquisition profit. The post-acquisition profit, you have to be very careful with it. There will be an issue in the post-acquisition profit that will not be relating to profit. It will be relating to what? Revaluation surplus or other issues. Okay. So what you do is that you have to be able to determine the profit and also the revaluation surplus. The parent will take each share of the revaluation surplus to its reserves, whereas they will take the share of the post-acquisition profit to what? To their retained earnings. What do I mean by that? Okay, you will see that. What do I mean by that particular issue? You see that the retained earnings will be, let's assume that the share capital is still the same. The retained earnings will be 20,000 here, and it will be 25,000 here. Okay, other components of equity will be 15,000, and now will be 16,000. So let's assume that our share capital are the same because the share capital is going to have a zero effect on this one. It will be the same. You see that at acquisition, we will be having 35,000. Okay, but at reporting, we'll be having 41,000. What is the difference? What is the difference there?
6,000.
Okay, the difference will be 6,000. But you can see that this difference, the only one that is relating to the profit for the year is how much? The one relating to profit for the year is how much?
5,000.
It's 5,000. And other component of equity is what?
1,000.
It's 1,000. So what I'm saying that you have to be able to what? To distinguish between the items that are causing the difference. Don't just go and share the what? The 6,000 as post-acquisition profit. No, the only profit element over here, which is relating to the retained earnings, is 5,000. So you can only share 5,000 where the parent will take each share to retain earnings, group retain earnings. And this 1,000 will be shared among the NC and the parents. The parents will take each share to other components of equity. So if you are preparing the net asset to know the post-acquisition profit, the figure that you are going to be getting might not be the post-acquisition profit for the year. It will include what reserves. You have to be able to what? To differentiate the two. Because the parent will take each share of the reserve to their reserves, not the retained earnings. But whatever be the case, NCA will be having the share of the total 6,000 because you are going to share 5,000 and still share 1,000. So they will all have the share of the 6,000. Okay. So that is all about the net assets. If you are preparing statement of financial position, how do you tackle the question? You put the structure there, which I have said already. The next one is you tell the examiner the group structure, which means that what is the what? The ownership structure of the financial statement that you have prepared. So you put the group structure very well. So you can put the parents name here. So maybe P, then you put P, then you say that P is having 60%. And at this one, you put the date of acquisition because you have to tell them when the acquisition was done. That's because how are you having post-acquisition profit? What is the post-acquisition profit? You are saying that the company was acquired on this date and the reporting date is date. So from that particular period, this is the profit made. Between the reporting date and the acquisition date, this was the profit made. You have to tell them. So the date of acquisition, you have to put a date of acquisition there for each of the subsidiaries. You have to put their reporting date also there for each of them. Then you have to put what we call the post-acquisition period. So how many months or how many years was the subsidiary being acquired? So from the time of acquisition to the time of reporting date, how many years is that? How many months is that? That is what we call the post-acquisition period. Okay. After doing this, what else what has to come to your mind? This is how you go with the question. After putting your skeletons there, the next thing is what? Look at the group structure. The group structure is just telling us the ownership structure of the what? Of the company. Or the financial statement is being prepared on which what? What is the ownership criteria for the preparation? That is what we are talking about. When was the acquisition date? When was the reporting date? Post-acquisition period is how many years or how many months? After this, then you now count the net assets. Okay. The net assets, if there are two subsidiaries, you prepare the net asset for them one by one. If there are two subsidiaries, you prepare the net asset for them one by one. So the net asset, we don't do total asset minus liabilities because they will not give you the asset and liabilities at acquisition date. They will only give you asset and liabilities at reporting date. You can't tell which portion of the asset is at acquisition, which portion of the asset is at reporting. Because whatever be the case, there might be disposal, depreciation, acquisition of additional asset during the year. So we use the what? The liability method where we use the shareholders fund. So we start with the equity capital at acquisition, at reporting, retain earnings, they will give it to you, other component of equity, they will give you some fair value adjustments. Some of the assets might be increasing at the date of acquisition. Maybe they will say that the company is having a fair value of 5,000 above its carrying value. Okay, its carrying value. It means that if the fair value is 55,000, the carrying value will be 50,000. Okay, so right now, if asset is increasing and liability is constant, the net asset will also be increasing. So if there is an upwards fair value adjustment, you have to add it to what? To the net assets. because that was not taken into consideration before we determine the net asset. The net asset is always determined from the statement of financial position. That is the book value of the net asset. But at the date of acquisition, it's just like the company, the subsidiary has to value their assets to fair value before they sell. It's just like a business valuation. They are going to sell. So the asset must be brought to their what? Their market values. So you fair value the asset before you what? You sell. That is the basic assumption about the fair value adjustment. If you are selling an asset, you have to ask yourself, okay, this today, what is the value of the asset? I have to sell the asset at this particular value. That is the same assumption that they are going to be applying over here. So you fair value the assets, the liabilities, you fair value them. Some of them may bring issues of deferred tax. Some of them will bring issues of deferred tax assets. How do you go about it? You prepare your net assets. The next issue is, what is the portion of the net assets is the parent buying? The parent cannot buy all the entire holding of the company. They cannot buy 100%. Okay, there will be a portion that will be remaining. Okay, so the portion, the percentage holding that the parent is buying, what is the value of the asset? And what is the value that the parent is not buying? So what's the value of the assets? If the parent is paying for asset that has a value of 600 million, and the parent is paying a total amount which we call the purchase consideration or cost of investment, the parent is paying 650. You can say that the parent is paying for what they are having. They are paying more for what they are having. The physical items that we can see, their value is 600 million, but the parent is paying 650 million. They are paying for something that we are not seeing. That particular thing might be the expertise of the employees. The parent might see that the employees of the subsidiary is going to what? Give them a lot of things. The parent must also be paying the 50 million for the customer base that the subsidiary is having. The parent must also be paying the additional 15 million for the location of the what? The subsidiary. Maybe the location is very strategic, that is going to boost sales for the parent. The parent might pay for that particular one. So whatever be the case, the parent is paying for what we call internally generated goodwill, which the parent will now be recognizing as goodwill. So if the parent is paying more for what they are acquiring, the excess amount is recognized as intangible, which is goodwill. It might be the location of the company. It might be the expertise of what? The employees. It might be any other issues. We can also have a situation where the parent is paying less for what they are buying. That is what we call gain on buy, gain purchase. So you have to determine your goodwill. Whatever be the case, you have to ask yourself, you have to determine whether the parent is paying more or they are paying less. So you have to determine your goodwill. The goodwill, you have to look for what is the amount that the parent is paying, which we call the purchase consideration. The amount that the parent is paying for the shares in the investee is what we call the purchase consideration. And this particular purchase consideration can be settled in so many ways. The parent can pay for the shares in cash, so we call cash consideration, or they can even pay check. They are all under cash consideration. Okay, so they can pay cash or check. They are all under cash consideration. Okay, so the parents can also say, we don't have cash, so we are going to give you shares. You also come and be part of the what? Owners of us. So the parents can also do what we call share consideration. So instead of us giving you cash, we are going to give you shares. We want you to be part of the shareholders of our company. So we are going to give you shares. So it can be through share exchange. The share exchange, you have to be very careful with the share exchange because they are going to be giving you a proportion in which the share exchange will be done. They can say that it is 2 for 5. The 2 for 5 means is that you are giving 2 new shares for every 5 shares the parent is buying. So the only way to know the share that the parent will be giving is just 2 over the 5 multiplied by the share that the parent is acquiring. That will give you the number of shares that the parent is giving to them. Okay. We are not looking for a number of shares. We are looking for the value of shares. Assuming the parent wants to sell that particular shares, they want to settle the consideration of 100,000. Okay. They will now do the share exchange of 2 for 5 times the number of shares. Then this share will now be what? issued to what? Outsiders, third party at their share price. So the parent will receive the cash and pay the shareholders of the subsidiary. So to calculate the number of shares, it is the 2/5. If they say 1/5, it is 1/5 times the number of shares that the parent is buying, multiplied by the parent share price. How do you treat that particular one? You just assume that the parent has issued the shares to outsiders. The parent has sold the shares to outsiders. If they issue the shares, our cash will be increasing. Then our equity shares will also be increasing. So the cash that the parent is receiving, which is 100,000, the parent will now use this cash to pay for the shares that they are buying. So you see that cash will still be what? We are going to be debiting the investment that we are having, then we are going to be crediting the cash. So whatever be the case, our equity shares will be increasing. So you just assume that the parent is issuing shares to buy the investment. So the equity shares will be increasing. If it is yet to be recorded, you add the portion of the shares and you add that particular value to their purchase consideration. They can also do this one through what we call a deferred consideration. We can also do this through what we call a deferred consideration. Okay, the deferred consideration is, okay, we don't have cash now, but we are going to pay you people in 2 years' time. Okay, the issue always is if the parents should have cash, the amount that they are paying in 2 years' time will not be the same as the amount that they'll be paying today. So you just ask yourself, you are selling something to me today, and I'm saying I'm going to pay in 2 years' time. The meaning is that you are going to consider time value of money. So you are going to consider some component of interest because I'm be holding your money for 2 years. If you have the money today and invest somewhere, you're going to be getting something on it. So you have to factor that particular thing in. So the question is, we find what should have been the cash consideration at this date. We present value this particular deferred consideration using the cost of capital of the parent. So if the parent is paying 100 million in 2 years' time, but if the present value is 80 million, it means that if the parent should have cash today, they will pay 80 million. But since they are not having cash, the company is charging them what? 20 million interest. So it means that the company will be incurring interest cost of what? 10 million every year. This will be charged as what? As a finance cost. Deferred consideration is a liability because the parent is going to pay this amount to the people. They are owing the people. So you take the deferred consideration to statement of financial position as a liability if the question says that it is yet to be recorded. But if they say that they have already taken the deferred consideration into consideration, it means that they have debited their investment and the deferred consideration is part of their what? Their non-current liabilities. Another one can also be a contingent Another one can also be what we call contingent consideration. A contingent consideration, that one, what we are doing is that we are not saying that we are going to be paying you. No, we don't agree. We haven't agreed on any amount. For the fair consideration, we have agreed on amount and we are saying that I'm going to pay this amount in the future. But a contingent consideration is dependent on what? On something. That's what they say, a contingent. It depends on the occurrence of a particular issue. So we are saying that since you people are not making profits, we are going to be paying you this amount if the profit increase by this percentage. And we are going to pay you this amount if the profit decreases by this percentage. So this is going to be based on what? On our occurrence of a particular event. Always a performance what? Target. Always a performance target. So at the date of acquisition, you have to determine the fair value of the contingent consideration. The contingent consideration will also be classified as a liability because you are having a financial obligation towards what? The former shareholders of the subsidiary. You are going to be paying this amount to them. So at the end of every year, you have to fair value it. There might be increase, there might be a reduction. So if at the date of acquisition is 15 million, it is now 16 million, it has increased. That is that is a loss to what? To the parent. So the 10 million will be treated as a loss. If 50 million has reduced to 45, it means the liability has reduced. That is a gain. And that particular one will be treated as a gain for the parents. They can also do the consideration by issuing of what? Loan notes or preference shares. They can also settle the consideration using issuing loan notes or preference shares. Okay. Listen, when there's a self-subsidiary and effective interest is determined, is the effective interest used throughout the consolidation? Yes, please. Yes, please. If you want to, if you count to the share of the subsidiaries profit, you use the effective interest to determine their share. Or you can also decide to take the subsidiary share. If it is 60%, you take the 60% of the share of the profit of the subsidiary. Then that particular 60% of the profit, the parent will now be taking its own share of it. It will give you the same answer as the effective interest rate. The effective interest rate, we are just saying what is the share of the operations in the subsidiary. What is the parent share of the operations in the subsidiary? That is how we determine the effective interest. That is the reason why we determine the effective interest. Someone can also decide not to determine it, but the person will say that any share of the subsidiary profit, the subsidiary will have a share of it. And the share of that one will be added to the share of the profit of what? Of the subsidiary itself, which will be shared among the parent and then the NCI of the what? Of the subsidiary. So you can also use the same method, you'll be getting the same answer. So we use the effective interest rate throughout the consolidation. That is for the share of goodwill, the share of post-acquisition profits, the share of impairments, and any other issues. All right. So we can also issue this using loan notes or preference shares. So the parent will give them loan notes, okay, or preference shares. You see, whatever be the case, the basic way to understand this is that you just assume that the parent has issued the shares to what? To an outsider. And they have used the cash to pay for what? The shares that they are buying. That is the only way. So if they are issuing the shares to the outsider, we are going to be debiting cash and crediting the loan notes or the preference shares. Okay. Why did the parent issue this one? They have issued this one because they want to buy shares in the subsidiary. So they will now be using cash. So you now credit cash by the same amount, which may be maybe 10 million or something. Then what will happen? The parent will now debit the investment because they are buying shares in that particular company, 10 million. So whatever be the case, you can see that the cash is going to be having a zero effect. That's why we don't bring cash into the question. We only bring the investment, debit the investment, then we debit the loan liability. The parent is saying that we want you people to be loan holders of us. We don't have cash to give to you. So come and be part of the loan holders and we'll be paying interest on your loan. So if it is through loan notes, you just determine what is the value of the loan notes, and the parent will now be paying interest on it because it's a liability. If it is the preference shares will still be treated as what? A liability, where the parent will be paying dividend on it. So you have to be very careful. The parent will be acquiring the equity shares by issuing preference shares. The same way the parent can also buy preference shares in addition to the equity share. There are two different, this particular transaction are two different transactions and have two different treatments. One of them will be the parent is what? Issuing the loan notes as in exchange for the shares that they are buying. In that particular case, the loan note will now be part of the what? The purchase consideration. But we also have a situation where the parent will be paying for the equity shares, all right, and still be buying preference shares in addition. It means that they have already paid for the equity shares, but they are buying preference shares in addition. Preference shares does not give ownership. If the acquisition is done, the subsidiary is now owned by the parents, and the parents will now have the liabilities of the subsidiary. So if the parent is buying part of its own liabilities, it means that the parent is paying back its own liabilities. So the preference shares will be removed as an asset under the parent, and also be removed from what the liabilities of the subsidiary, because the parent is paying back part of its what debt, which is the preference shares. Because after the acquisition, the subsidiary is now owned by the parent. And if you own a particular company, it means that their assets and liabilities are now your responsibility. So if you are paying back part of your liabilities, it means that, or if you are buying it back, or if you are buying it, it means that you are paying part of it off. So that will be treated as intra-group what transaction. All right. The purchase consideration can also be settled through transfer of non-monetary what item. It can be transferred. They will give you PP. They can give you assets. They will give you assets. We don't have money, but we have building. We want to give you the building. It's just like we are selling the building and giving it back to you. So we are selling the building and giving the proceeds to you. That is the meaning. I'm owing you, I don't have money. I'm giving you my house. The meaning is that I have sold the house to a different person and I'm giving the money to you. It's just the meaning. So the PP that is being transferred, the PP that is being transferred, they will give you the carrying value and they also give you the fair value. You assume that you are selling the PP to a third party. Therefore, the PP will be sold at a fair value. So if the carrying value is 50 million and the fair value is 55 million, if you sell it, it means that you are making a gain of 5 million on it. So the PP will be transferred to the former equity shareholders of the subsidiary at fair value. If this is yet to be recorded, then you now record it. There will be a gain on it, and you go and remove the carrying value from the PP because it is the carrying value that is included in the PP. So you have to go and remove that particular issue. So you have to calculate goodwill. You also have to do the calculation for the NCI, which is the portion of the equity shares that you don't have control over. Formerly, it was called a minority interest. The parent will be having a majority interest, and those people are the ones that are minority shareholders. But now it is called the portion of the interest that the parent is not controlling. So we have the non-controlling interest.
So, Linus,
Yes, yeah.
this 5 million, is it going to OC or retail earnings?
It will go to retain earnings. It will be treated as a gain on disposal or profit on disposal.
Okay.
All right. Okay. So you find the NCI. What is the NCI at acquisition? They will give you maybe proportionate method or full goodwill method. You have to know how to go about that one. You put the NCI at acquisition. What will increase it is their share of the post-acquisition profit. What will reduce it is the impairment if they are using full goodwill method. Full goodwill method. You put it there and you move on. The next one is group return earnings. You put a group return earnings there. It's also part of the what? The major what? Workings. Group return earnings. This return earnings is for the parents. So group return earnings is part of the major calculations. Then other one will be maybe you have other components of equity. If there is any, you do workings for it. Another minor issues will be maybe additional depreciation as a result of fair value adjustments. There is maybe provision for unrealized profit. The parents have sold goods and they have recognized all the goods are sold. Now part of them were not sold. Profit will not be on it because the company is your own company. So if you are giving goods to them, you are giving the goods to them to sell on your behalf. Whatever be the amount that they have sold is the sell for you. So you have to remove that particular profit. Those are the what? The minor calculations. So after putting your skeletons there by adding the items, the next one is put the group structure there. Try to put your net asset there. Try to look for your goodwill. Try to look for your NCI. Try to look for your what? Your group return earnings and any other calculations or workings that you can do. If you cannot adjust one footnote, that is not the end of the world. Move on to another one. Leave that one. You are working within time. Adjust the one that you can adjust and leave the rest to God. So this is basically about statement of financial position. If you come to statement of profit or loss, this is the what? The most easiest of the consolidation. You are not asked to do anything. the only calculation that you can show is the group structure, because you don't need net asset at acquisition, net asset at reporting, because the profit or loss, you are going to be determining the profit from that account already. So why should you prepare net asset to know profit after acquisition? No, because the profit after acquisition will be determined in the statement of profit or loss, which you are going to share among the NCI and the parents. So we don't prepare net asset over here. We prepare only group structure. You put only the group structure over here. Even the net asset that you are going to be preparing will only be at acquisition, because you are going to be the net assets calculation that you'll be doing is at acquisition, because you are going to be calculating a goodwill. Maybe they will tell you a goodwill impairment of 5%. So you have to know the goodwill before you know the impairment. If you are giving the impairment value of the goodwill already, you don't have to do any workings for net assets at acquisition. You don't have to do any workings for goodwill if the impairment of the goodwill is already given to you. But if the impairment of the goodwill has not been given to you and they give you a rate, then it means that you have to work the goodwill yourself. Then you apply the rate on it. So you are going to do the goodwill as part of the workings. You don't have to show workings for NCI. We only do the NCI because we want to know the NCI value in the statement of financial position. We are not preparing statement of financial position. We don't do calculation for NCI unless the question asks you that you should prepare NCI. We don't do group return earnings because we are not sending this figure to statement of financial position. The only workings that you do is the excess depreciation or additional depreciation or provision for unrealized profits. For the profit or loss, you have to be very mindful with the consolidation. It's very simple. You are selling from the morning to the evening. Okay, from the morning to the evening, you are selling from 6 a.m. to 1 p.m. and you have made a profit of 200 cedis. I've given money to you from 1 p.m. to 6 p.m. At the end of the day, you have made a total profit of 450. This total profit, 200 is for 6 a.m. to 1 p.m. and this will be 250. From 6 a.m. to 1 p.m., I haven't given you the money. So my money does not generate any profit during this particular period. So the 200, I will not have any share of it. So from morning 6 a.m. to 1 p.m., the profit that you have made during that particular period, I'm not going to have any share of it. But the profit that you have made from 1 p.m. to 6 p.m., which is 250, I'll have share of it because I've given you money from 1 p.m. to 6 p.m. So the profit generated over there, it means that my money is part, or my money has also generated some of the profit. So you give me the share. This is the same thing that works for what? The profit or loss. We only look for what is the portion of the profit that the parent is going to have a share of. How many months profit? So we consolidate the subsidy for the number of months profit that the parent is going to have a share of. If the acquisition is done on July 1 and the reporting date is December 31, you can see that from January to June, the parent is not going to have any share of this particular profit. So we don't consolidate from that period. But from July to December, the profit made over here will be shared among the owners and the parent will be having share of it. So you only consolidate what? For 6 months. So you prorata the profit or loss items. The question will always tell you that you should assume that the revenue and expenses are assumed to be accrued what? Evenly. So it means that every month you are having the same amount of revenue. So you just use monthly basis to what? To find the post-acquisition items. It is very important. For a statement of profit or loss, the tricky side of it is the month of consolidation. If the acquisition is for full year, you consolidate for full year. If it is for 6 months, you consolidate for 6 months. That is it. You see, any question that you are going to be taking, group structure is constant for all of them. You have to show the group structure. Either it is step acquisition, profit or loss, statement of financial position. Group structure is very important. It's very important. So Basically, I don't have to talk about all the issues because we don't have time. Then we are going to be picking questions. Then we now demonstrate what we are talking about. So we try to solve questions on. So I have more questions here. We try to solve the two more questions because it's very important. And we try to pick a question on complex group structure. Then we see how far. So let's see whether we can deal with 3 questions today. And maybe the remaining ones, I'll just solve them and share the solution with you. If I have time, we can just organize them and we go through them, or we can even discuss the footnotes, and that is the end. Okay, so someone should take the question 1 for us, then we move on. Augustine, are you there? Please, someone to take the question 1 for us.
Summarized financial statements for 3 entities for the year ended 30th June 2022 are provided below. So you have Jamasi, Aguna, and Mountain. You have the various
Who is the parent there?
So the parent is Jamasi.
Okay, so after seeing this question, what are you going to do?
So you put up your structure and then you put in all Jamasi's figures, except the investment.
Okay, okay. Okay.
Additional information. On 1st January 2022.
Okay.
On 1st January 2022, Jamasi acquired 60% shareholding in Aguna at the following consideration, which has not been recorded in Jamasi's books. 1 share in Jamasi was given for every 3 shares in Aguna. At acquisition date, the fair value of each share of Jamasi and Aguna were 6 and 2 respectively.
Can we start with the structure?
I think so.
Okay. So this one, if this one, you don't have to go and read the requirements. You see, whatever they are going to ask you, they will ask you to prepare the consolidated statement of financial position for Jamasi as at this date. The date will still be the 30th June. Okay. So you just put the structure there. Don't look at the footnotes and don't go to the footnote. Just look at the question. Start with the skeleton. Put the structure there. Putting the structure there will give you a form of view. Because if you want to go to the footnotes, you read the footnotes, you don't know what to do, then you are already what? Discouraged. You don't know what to do. So don't go there and even some of the things that we do is that they say you should not open the answer booklet until you are told to do so. As soon as you open it, you will see something and you don't know. So you will start thinking about that particular thing. As soon as how should I go about this one? Then you feel down. You will know the thing, but because you are down, you don't know what to do. So put your structure there. Put your structure there. And you move on. Put your structure, put your structure there. And you move on. So we have the Jamasi group. So you put a consolidated statement of financial position as at, okay, if you go to the exam hall, then you put a date there. Okay, this place that we are practicing. So we start with the PP, isn't it? Okay. Jamasi figures were what?
1,580.
Okay. 1,580. Can you pick the investment figure for me?
Yeah.
So they have 2 investments, isn't it?
Yes, they have IP and investment.
Okay. So what you do is that so they have investment property and also the investment. So the investment, you leave the investment. It might be investment in the what? In the subsidiary. So you leave one of them and You just pick the investment property. So we have the investment property is how much?
650.
Okay. So the investment over there, since they say investment, it might be the investment in subsidiary or other investment. Whatever be the case, we are going to be reconciling it. Okay. We are going to be reconciling them. Let's come to the current assets. So what you do is there might be other investments, but whatever be the case, you can write goodwill here because goodwill might be arising. If there's no goodwill, you just put dash there. So you can leave like maybe 3 lines, then you come to current assets. So the current asset, we have the inventory. Inventory is how much?
Yes. Inventory 490.
490. The next
Other
item,
current asset.
okay, other
Current asset.
current assets,
360.
okay, 360. Then we come to equity and liabilities. Okay, the equity we show only in that of what? The parents. Okay, so equity and liabilities. We have the share capital.
Share capital.
Okay,
1 CD.
is what? Yeah, you forget about that.
1,400.
Forget about that at 1 city, 1,400. It's not something that is going to give you mark. It will just waste your time. So put the share capital there. Then you put the retained earnings. The retained earnings, you'll be doing workings for it. So don't do anything there. Because if you want to add, there are a lot of issues that you are going to be adding, which will not have space in the answer booklet. So just go and do workings for it. Do you have any other item under the equity?
Yeah, other components of equity.
The other components of equity, you show only the parent own. This might also be having
750.
other issues, so you can decide to go and do workings for it. If the items that you are going to be adding will be plenty, you can do workings for it, or you can just add in the bracket. Then we now come to NCI, non-controlling interest. You do workings for that. Then the next one is what?
Liabilities.
Okay, they'll just put the liabilities there.
Yeah.
Okay, so they have liabilities. Were they grouped together or they were classified?
They are put together at 450.
Okay, they just put liabilities there as 450. Okay. So after getting this, you just have to take in some fresh air, or they will give you water. So you can decide to take the water to cool down the temperature down. Okay. Then you now take the first footnote.
In January 1, 2022, Jamasi acquired 60% shareholding in Agona at the following consideration, which has not been recorded in Jamasi's books. One share in Jamasi was given for every 3 shares in Agona. At acquisition date, the fair value of each share of Jamasi and Agona were 6 CD and 2 CD respectively.
Okay. So you can see that Jamasi is now having a subsidiary, isn't it?
Yeah.
Who is Aguna? What you do is that scan through and see whether there is a disposal of equity shares in Aguna. You just scan through because you have to be sure that they are still having 60% so that you can consolidate. Okay, you have to be very sure that they are still having the 60% so that you can consolidate. Okay, so that you can consolidate. So you scan through and see if they have any acquisition over there. Okay, you can see that there is no disposal over there. Then it means that they will still be having 60% and they have to consolidate. So you go and now add the Agona's items to that of the parent own. So let's look at their PPE. Agona's PPE is what?
840.
840.
840.
They don't have investment property, isn't it?
Yeah.
But they have inventory.
330.
330. Okay, then you go to the other current assets.
That's 260.
260. Then you come to their liabilities.
240.
240. The share capital will not count. The share capital will cancel the
The investment.
The investment, and then the excess will be treated as a goodwill. Okay, so let's now look at what they are saying. They are looking at, they are telling you how the acquisition is being done, isn't it?
Yeah.
How the acquisition is being settled. So from this particular place, you can now start your workings because you know one already. So we can start our workings here by putting the workings, by putting group structure. So we can have our workings here, and you have the group structure. So you have your group structure. Then you now put, you can put this particular thing there. You can do it like a triangle, not a triangle. You can do it like a rectangle, and or you do it like a table. You put the acquisition in a table. So Jamasi is the parent. Okay, who is having 60% in what? In Agona, isn't it? Okay, so you put the acquisition date here. The acquisition date was what? June? Is it January?
Yeah, January 2022.
Okay, so you have January. So you put acquisition here, maybe you just put a date here. So this one, you can draw a line over here. You can draw a line over here. You can draw a line over here. So January 2022. Then you come to the reporting date. The reporting date is June what?
June 30, 2022.
Okay. So the post-acquisition is what? Post-acquisition period is 6 months. Okay.
Yeah.
So you can just do it like this. And okay. So for this particular one, since you know one subsidiary, you can go ahead to determine their net assets. So you want to know the post-acquisition profit, that will be for Agona. Okay. So you come to the net assets, you have at acquisition and at reporting. Some people, they like putting post-acquisition profit over there. Me, I'm dealing with time, so I don't always do that. I'll just put my figures over there. At the end of the day, I'll just subtract. That will give me my post-acquisition profits. So if you like, you can add it like that. And so we have the share capital. The share capital, the one in the statement of financial position, will still be the one at acquisition because there is no movement in the share capital. So Agona is having how much?
Agona is having 840.
No, the share capital.
Oh, sorry.
Yeah.
650.
Okay. So please, let's all be participating so that the thing will stick. So reporting will still be 650. The next one will be the retained earnings, isn't it? Okay. The retained earnings is what?
510.
At acquisition?
Oh, sorry.
At acquisition is 510. Okay. At acquisition is,
No,
at reporting is
at
510.
Oh, that's reporting. That's reporting.
That is reporting. So
Well-
510 at reporting.
Okay. So let's now go and look for the acquisition. They'll always give the acquisition out to us, or they can also give us the opening balance and give us
It's
profit.
300.
Okay.
300.
So it's 300. Let's take the other components of equity also at 120. Okay. So that is 300. And the other component of equity
At reporting is 200.
at reporting is 200, isn't it?
Yes, please.
At acquisition is what?
120.
120. Okay. So those are the net assets from the statement of financial position. So these figures are calculated from the statement of financial position. At the date of acquisition, the owners of the company must fair value their asset before they sell. So they will now look for a fair value of the assets. So they have to fair value, just like business valuation. Okay. You forget about, don't tackle the purchase consideration. tackle the purchase consideration if you are going to calculate goodwill. Because maybe if you are reading the purchase consideration, you might read an item there or a word over there that is going to get you confused, and you'll be confused forever. So leave that particular portion. Come and do your net assets. Because the net asset, you don't need to read anything. The only thing that you need is at acquisition, the retained earnings is this. Other components of equity is this. That is all. What are they saying about the fair value? The non-controlling interest.
So they said the
And the fair value of the non-controlling interest was what?
340.
Okay. So what you do is move from that particular side. You don't have to do your workings in order. So you can ignore, since you have non-controlling interest, you can put your non-controlling interest here. So maybe you can make it the workings 3, since you have access to that particular information already. So you come to fair value at acquisition. So at acquisition, it was 340. Okay. So you don't have to go and do your workings in order. Okay. As soon as you have access to the information, go and put it somewhere. Okay. Let's now come to the fair value adjustment. What are they saying? B. Let's tackle the B first before we move on to the A. Okay. So the carrying values of Aguna's net asset were equal to their fair value except the following. Okay, so let's take that one. A property, plant, and equipment was carried at 50 million. So in the book, it was what?
50 million.
Okay. This PP had a fair value estimated at 80 million. At acquisition is now what?
80 million.
So what is happening there?
There's a gain, evaluation gain of 30.
Okay, there is an increase at acquisition of 30, isn't it?
Yes.
Okay, it means that this particular 30 was not considered before having this net asset, isn't it? We only consider 50. So what will happen is that we now have a
Can you come again?
Okay, the fair value adjustment. Okay, the figures that we have over here, the 650, the 300, the 120, all over here are based on the book values. They are based on the book values in the statement of financial position. But they are saying that the book value of a PP, which is 50, has now increased to 80. It means that the time that we are calculating the net asset, we only consider 50. We only consider 50 because it is the 50 that we have in the books. And the net asset is calculated from the books. So we consider only 50. But now it's supposed to be 80. But we have already recognized 50. We need to what? Add the what? The 30 back. So the 30 will increase here. The 30 will increase here. The first question is the PPE a depreciable asset? If yes, people have so many ways of doing it. But let's do it like this. So the 30 will increase at acquisition and also at reporting. What will happen to the PPE in the statement of financial position?
Increase by 30.
This must increase by 30. Are we okay? All right. Let's now go to this. They have not recorded a fair value adjustment. Let's come to the end part of this particular one. The remaining useful life of this PPE was 5 years at the date of acquisition. When are we recognizing the 30? When do we recognize the 30 now? It's not at the date of acquisition. The 30 was recognized at the date of acquisition, isn't it?
Yes.
Which is January 2022. But what is today's date? What is today's date?
30th June.
It means that we have used 6 months of the asset, isn't it?
Yeah.
So the remaining useful life will be 4.5 years. So that 6 years that we have used, we have to charge the depreciation because the depreciation was not charged. The fair value adjustment will be recognized at the date of acquisition. So you assume that you started using the assets at the date of acquisition. But today is 30th June, you have used 6 months. It means that the asset will still not be having a 30 million. It will reduce by what? The depreciation. So let's go and calculate depreciation on this particular item. So you can do your depreciation somewhere here. You can say additional depreciation. You don't have to go and do workings. You can do the workings here by having the 30 over 5 multiplied by 6 over 12. Am I correct?
Yes, sir.
Okay. Depreciation is supposed to be taken from profit, isn't it?
Yes.
Where is the profit over here? Where? Under the net asset. Where can we find the profit? At acquisition,
Return.
at acquisition or reporting?
Reporting.
Yes. The
At
asset
reporting.
will be used to determine profit for the year, and the profit for the year is at reporting. What will be our depreciation?
3.
Okay, so that will be a reduction of 3 million. What will happen to the assets? The assets are supposed to be 27 million, isn't it? The remaining value of the assets are supposed to be 27 million, not 30 million, but we have added 30 million. So we have to come and take 3 million to make it now 27 million. Are we okay with that? Are we okay with that? Or I should...
Yeah, we are okay.
Okay. Okay, so we are done with the first footnote. Let's come to the second one before we go to the purchase consideration. As soon as you are done with the net assets, you can now move on to what? Goodwill calculation. Okay, let's now look at the second issue. Yeah, Snianik, take the second issue for us.
Fair value of property, plant, and equipment that Aguna at acquisition had made a decision to sell, which did not change despite the acquisition, was 35 million. But the historical cost carrying value was 50 million. The estimated selling cost of the asset on this date was 1 million. The asset was yet to be sold as of 30th June 2022, and the above Aguna's financial statement is yet to reflect the decision to sell the asset and any fair value adjustment.
Okay, so what are they saying? They say that at the date of what? At the date of acquisition, the company, Aguna, has made a decision to sell an asset, isn't it?
Yeah.
Okay, so the question now is, we know IFRS what? 5. We know what is the requirement, but the question is, when was the decision made? When was the decision made? The decision was made at the acquisition. Who made the decision? It is the subsidiary, not the parents.
Yeah.
So what you do is you ask yourself, what is the value of the assets? If they want to classify the asset as held for sale, they will classify the asset as held for sale before we buy. Not that we buy before we come and classify. No, the classification will not be done after acquisition. It will be done at the date of what? Acquisition. So if they want to classify this particular asset, what will be the net realizable value, or at what value are they going to be classifying this particular asset? If they want to classify the assets, at what value? You see that in their books, the asset will be at 15 million, isn't it? In the books of the subsidiary, the asset will be 15 million, isn't it?
Yes, please.
Okay.
Yes.
Because
Yes, sir.
the classification to be the lower of the carrying value and then the what? The net realizable value. So the net realizable value is 34 million, and the carrying value is what? Is 15 million. But we are now buying the assets. We are now buying the asset. The asset must be what? Must be fair valued. But if it must be fair value, you have to take into consideration the what? The the cost to sell. Okay, the asset will be fair valued. The asset will be fair valued at 35 million. Okay, but since the decision is to sell, it means that we are going to take the asset at 35 million and now what? Incur a cost of what? 1 million on it. Okay. You can decide to do this one in two ways. Okay. The decision has not changed. At the date of acquisition, the asset will still be classified. If the asset is being classified, what will happen? The asset will be at 15 million. But what is going to happen is that at the date of acquisition, all the assets and liabilities of the subsidiary must be fair valued. So this particular date, the net realizable value of the company will now be 34 million, and the carrying value will be what? 15 million. What is going to happen? In the books of the subsidiary, they will be having 15 million. But at the date of acquisition, if they want to fair value the assets, assuming they are going to sell the assets, the net realizable value will be 34 million. So the parent will take the asset at 34 million. It will be fair valued to a market value. That is the business valuation. So in your books, the asset is 15 million. But they are saying that if you want to sell this particular asset in the market now, you are going to be receiving 34 million. If someone wants to buy it, you sell it to the person at 34 million. So you take the fair value. Oh, who is that? Okay, so you just take the fair value. All the asset must be valued at fair value. But at acquisition, net the 1 million against the fair value. So you now take 34 million for this particular asset. So you take 34 million as a fair value adjustment. Is it plants? So you have plants to be 34 million and reporting will also be 34 million. Okay, so that is it. And we don't do what? We don't depreciate what? Asset held for sale. We don't depreciate asset held for sale. What is the carrying value of the asset in the books of the company?
15.
15. Okay, what do we do? A held for sale must be disclosed as what? A separate item, isn't it?
Yes.
So a head for sale will now be 34 million. Then we go and take the 15 over here, which is the reclassification. Are we okay?
Yeah.
We go and take the 15 from the PPE and now classify the asset as head for sale. So head for sale must be classified as, so we have the head for sale must be classified as a line item, must be shown as a line item. That is about that particular one. Let's now go to
the positioning. Is it?
Hello, Linus.
Yes, Senior.
Please, I'm confused though. The fair value adjustments.
Yes, please.
Usually, when we do fair value adjustment, like the one that we did,
Yeah.
we added the difference to the net assets. But this time, it seems we are adding all the 34,000.
Sorry, it's supposed to be the difference because we have 15 already. Sorry. Sorry. So the difference is what?
19.
Sorry, 19. Thank you. So we have the difference. It is the difference. It has increased by the 19. Sorry. Thank you very much. Okay. So they have already recognized 15. What value do we have to add to make it a 34? Senior, thank you. All right. The group follows cost model for subsequent measurement of all property, plant, and equipment. Okay. So what they will say is that as soon as you have classified the asset as held for sale now, which is 34 million, at the end of every year, you will now look for maybe the fair value, you fair value again, or you remeasure again. There might be a loss or there might be something, so you go about it. Let's now look at the A. So we can now adjust the A to know whether we are having a goodwill or we are having gain on bargain purchase. Sina, can you take the A for us?
On January 1, 2022, Jamasi acquired 60% shareholding in Aguna at the following consideration, which has not been recorded in Jamasi's books. 1 share in Jamasi was given for every 3 shares in Aguna. At acquisition date, the fair value of each share of Jamasi and Aguna were 6 and 2 respectively. Additional consideration shall also be settled in fixed number of Jamasi's equity shares 2 years later, provided that profits are going to exceed a certain benchmark. The fair value of this conditional payment at acquisition date was estimated at 143 million, which has increased to 150 million on 30th June 2022. Linus, we should mute everybody.
See, are you done?
Yes, please.
Oh, sorry. I went to take water. Okay. So they are saying that the people they purchase what? 60%, isn't it?
Yes.
Okay. First of all, we have to know the number of shares that they are buying before we can do our calculation. So let's come to their shares. Their value of the shares is what? Is 60 million. That is the total value.
650. Yeah.
Okay. But one share is issued at what?
1 CD.
So it means that the number of shares is the same as the share value, isn't it?
Yes.
Okay. So they are buying 60%. And they are saying that they are giving one share in what? In Jamasi for every 3 shares in Agona. The question is, we first have to know how many shares that we are buying before we do the share exchange. So this one is just 1 for 3. 1 for 3. So let's look at the number of shares that they are buying first. Then we know what to do. So we can count to, maybe let me put over here the goodwill calculation here. Okay. So the goodwill calculation. Okay, someone has answered the question already. I didn't see that. So we look at the purchase consideration here. So the purchase consideration, we just put dash here, and then we come to the share exchange. So the share exchange, first of all, you have to ask yourself, what's the number of shares that we are buying? It will be 0.6 times 650, isn't it? That will give us the number of shares that they are buying. So that will give us what? 0.6. Okay, that will give us 390. Okay, this is the number of shares that we are buying. But they are saying that bring 1 shares, bring 3 of your existing shares for 1 new. So the question is, the existing shares is what? 390. How many of 3s can we have? How many of 3s can we have in the 390? So bring
130.
130. So you are bringing 130 of your shares for what? 1 shares. So it means that the 390 shares, the parent will be giving 130 shares of its own shares. That is the meaning. So 1 for 3, you just do 1/3 times the 390. That is the number of shares that the parent is giving. So the parent is giving 130 shares. Assuming the parent is selling these shares to the people, they will sell at their market price. So if you want to know the value of the shares, you multiply by this. So you do your 0.6 times that divided by 1/3 times 1/3 times the market price of the parent times the market price of the parent, which is what? 6 cedis. Okay, so we multiply the answer by 6. Okay, I will still take that again. So we have 6 cedis. How much are we getting?
780.
Okay.
780.
So we have 780. All right. You see, another way of looking at this particular issue is this. Another way of looking at this particular issue is this one. Okay. The parent is buying 390 shares. It is the 390 shares that they are buying because they are buying 0.60% of the shares. So they are buying 390. And they are telling the people that bring 3 of your existing shares for 1 new. You have 390 shares, and they are saying that bring 3 of every 390 shares for 1. You are going to be bringing 130. So the parents will not be giving them 130 shares. Okay, it's just like the parent is what? Is issuing the 130 shares to an outsider and use the money that they are going to be receiving to pay for the what? The shares that they are buying in what? In Argo9. So if they are issuing this 130 shares to an outsider, it will be issued at the current market price, which is what? Which is 6 cedis. And they are going to be having 790. If they have the 790, their cash is going to be increasing and their equity shares will also be increasing. But what will happen? They will use the cash of 780 and now give it to what? The shareholders of what? Of the subsidiary, because they will use the cash to pay for the shares that they are buying. So what you do is you debit the investment and the equity shares will be increasing by 70. The parent is not selling part of, or the parent is not using the 70 to pay off its shares. No. We have 100 shares. Now we have 100 shareholders. Now 70 people are coming now. The total shareholders will now be 170. So don't say this will be reducing the equity shares of the parent. No, the parent is issuing existing shares or is issuing new shares to the existing shares. It's not that they are using new shares to pay for what, or they are using the existing shares to pay for whatever they are buying. No, the existing shareholders will be there, and these people will also come and add up to them. So what is the existing capital? This new capital, these people is coming as a new people. It is going to be increasing our equity share. So they are here to record this. You take your equity shares, which is 780, you go and add it to what? To the equity capital of the parent, 780, because they are here to recognize this particular transaction. That's the first part of it. Let's look at the second part. Okay. Additional consideration shall also be settled.
Okay. So,
You know, you don't know your mic is on. Don't worry, you'll be very fine. Additional consideration shall also be settled in fixed number of Jamasi equity shares 2 years later, provided that profit of Agona exceeded a certain benchmark. You can see that this is a contingent what? Consideration. Contingent consideration will always be based on what? On a condition. All right. The fair value of this consideration payment at acquisition date was what? Estimated at what? 143. So it means that if we have cash at that date, we should have paid what? 143 for the shares. So what we do is the total consideration that we are paying will be the share exchange if we have contingent consideration will be 143. Okay, so if we have money at acquisition date, we should have been paying 780 and also in addition to the 143. So that is about the contingent consideration. But what are they saying? Let's look at what is happening. At acquisition, it was 143, which has increased to 150 on what? Reporting. What is happening there? What is happening there?
So there is an increase.
Okay, there is an increase, isn't it? Okay, so our liability, they have not recognized this. This is supposed to be shown as a liability. So let's count to liabilities. How much are we going to be owing the people? How much are we going to be owing them at reporting in terms of the amount that we are saying that we are going to be paying them? How much?
143.
It will be 150. 143 is at acquisition. 150 is at reporting. So we show that the amount that we are owing them at reporting. You can show 143 plus 7. Okay. You can show 143 plus 7. There is no problem with that. As soon as we have access to that particular information, we can now go and do our group return earnings, because we have one item that will go to the return earnings now. So we have the group return earnings, which is for the parent itself. So let's have the parent return earnings. What is the parent return earnings figure?
$930.
$930.
Okay. Who is going to be paying to the shareholders of the subsidiary? Who is paying the amount?
The parent.
So the parents say that they are going to be paying 143 at acquisition. Now it has increased to what? 150. What is happening there?
There's an increase in liability of 7.
So there is a loss on the what? On that particular one of 7, isn't it? The parent is going to be increasing a cost. That is a cost to the parent. That is a cost to the parent. So that will be recorded here. If it is reduction, it will be recorded as a gain. The difference will be recorded as a gain. So that is all about that. Yes, yeah.
So with the why don't you correlate the 7 for the liability? Because I was thinking the 143 was paid now. So
no, they don't pay. They haven't paid.
The 143 will be paid.
They are going to pay in 2 years. In 2 years later.
Oh, okay.
So the amount to be paid in 2 years later, provided that the profit of Agona exceeded a certain benchmark. So if you are in 2 years later, we are going to pay you this amount. If only you are able to achieve this particular profit target. But at today's date, we are saying that if we should pay you, we're supposed to pay you 143. So we are going to be paying you 143 in 2 years' time, as of today. That is the fair value of the amount that we are going to pay you in 2 years' time. At the reporting date, this has now increased to 150. So in our statement of financial position or in our records, we are going to be having 143. Now it has increased to what? 150. It means that we have remeasured the liability at the reporting date, and the liability has increased. That is a loss. That is a loss to the parent. It's just like a remeasurement loss or maybe a translation loss. Maybe you are translating the liability has increased, but you call it a remeasurement loss. All right. So, Sinadebra, I hope you are okay with that.
Yeah, I'm okay, sir. Thank you.
Okay. So we are done with the.
Hello, Linus.
Yes, yeah.
Please, I have an issue.
Okay.
You know, this 143, it was a share exchange.
No. The share exchange was a different one.
No, it says additional consideration shall also be settled in fixed number of Jamas's equity shares.
Yes, please. 2 years later, provided that profit of Agona exceeded a certain benchmark.
Yes, so they were not going to pay cash. They are going to pay shares, additional shares.
Also,
it said to be settled in fixed number of Jamas's equity shares.
Okay, additional consideration shall also be settled in fixed number of Jamas's equity shares. Okay. Okay. I'm listening, so you can come now.
Yes. So and you know, equity shares usually are not to be remeasured. Okay. Sorry, equity instruments are not to be remeasured. Okay. So here, I'm thinking the 143 should stay because it is going to be paid in shares, not fiscal cash, not a cash consideration, but rather in a form of equity instrument, which is the share exchange.
Okay. That is.
I don't buy into the idea of it because this is an investment, and they didn't tell us that they had the intention of doing it. So whenever there is changes, the value to be as fair value as
I wish we can hear.
Yes, her line is not clear.
Yeah, the line is not
some
clear.
Important statement, but her line is not clear.
Please, can someone hear me?
Yeah, we can try now.
Yes, I said, and we are not told that this investment will be sold anytime soon. So, as and when the value changes at report, we use the fair.
Oh, it is gone. Okay, I wish.
Fair value report, but not the do that.
Okay. Okay. Senior Socrates.
Yeah, Linus.
Okay. Okay. They are saying that this will be settled in a fixed what? Equity shares in 2 years' time, isn't it?
Yes.
Okay. If we are going to be giving you the 2,000 equity shares, this particular amount will be given to you at the share price of the company.
Okay.
Okay. This particular amount will be given to you at the share price of the company. It might happen that this will be based on the fair value movement of the share price, although the fixed number will be the same. It is 2,000. We agreed on 2,000. But if I should give you the shares now, maybe I will give you 143. That is the value as of today. But if I'm giving you the shares in 2 years' time, I'll give you the same number of shares at a different share price. The share price might reduce or increase. So although it's a fixed number of equity shares, it's going to be 2,000. We agreed on 2,000. But this 2,000 will be given at the fair value at the time that I'm giving it to you. If I'm giving the shares to you right now, I'm going to issue it at 6 cedi. Maybe that is the issue. By the time I will give it to you, if I want to sell it, I'm going to be selling it at 8 cedi. So at each reporting date, we look for the fair value of that particular contingent consideration. They can give you the share price and use the share price to determine it. If it is a contingent consideration, at the date of every period, you fair value the amount that they will pay. So they can give you 20,000 as the shares and they give you the 6 cedi over there. Today, you fair value it and see the today's value. At the reporting date, you still look for the fair value. If you want to give it to them, what will be the amount that you give it to them? Then you find the movement over there. Okay. Senior Socrates, I hope you're okay. All right.
All right.
Okay. Although
okay.
it's a fixed.
So please, the other effects.
Okay.
On the purchase consideration.
The purchase consideration.
Or we haven't gotten there yet.
The purchase consideration will always be, it's today that we are buying the asset. So if you should give the money to them today, it will be 143. So we only recognize the present value of it.
Okay.
The movement will be a loss. It will be a remeasurement loss. That will go to return.
Okay.
All right.
All right. Thank you.
Thank you very much. All right. Okay, so we are done with the footnote A and a B. That is very interesting. Let's come to the C.
Before the acquisition of Aguna, Jamasi had acquired 280 million shares of Mamponting on 1st July 2020 at a cash consideration of 450 million. On acquisition date, Mamponting's retained earnings were 185 million, and the other component of equity was 30. Fair value of Mamponting's net assets was equal to their carrying value, except contingent assets and contingent liabilities disclosed in the financial statements of Mamponting at acquisition date, which had a fair value of 20 and 25 million respectively. It is assessed that the probability of paying in relation to the contingent liability is more likely than not as at 31st December 2020. The fair value of the liability at 31st December 2020 was 35 million. The above financial statement of Mamponting excludes the effect of the contingent liability and the contingent asset.
Okay. Hey, this one, they are missing the date. It's supposed to be June. This stuff I didn't check.
Okay.
Yeah, so the 35 is supposed to be at reporting. Okay.
That's June 2022.
Yeah, it's supposed to be June 30, 2022, not this particular one. But let me see and see whether I can get the meaning of what they're saying. So at acquisition is what?
25.
25. Okay, so let's assume that this is a fair value. This is a remeasurement of the liability. So we can still maintain the date since they are all within the reporting date. Okay. So they are saying that the parents have acquired what? Additional what? Subsidiary, which is what? Maponting. So let's go and see the purchase consideration, the investment over here. Okay. You can see that the investment under the parent is 450. So that this particular investment is relating entirely to what? To the Maponting. So they are recognized only in that particular investment, which is 450. Okay. This means that the other subsidiaries are going to have investment on their own. The other subsidiaries are going to have investment on their own. So we can now bring our investment here for the other subsidiaries. Okay. But before we put the two together, let's go and determine whether the parent is having control over the other person or not. What is the total number of shares that they are buying?
80.
280 out of how many? So we have to know the number of shares that these people they have.
Out of 400.
Out of 400. So what will be the percentage?
70%.
Okay, so it means that they have,
70%.
it means that they have control over them too, isn't it? Okay, so we can just
Yes,
put Mapontino Jamasi over here. Then we have 70%. Then we have the Mampontin here. Then we put their acquisition date and those ones there. Okay. So we now come to their investments. So let's now add the Mampontin figures also to the parent one. So we have PP to be 580, the investment to be 170 and 180. So we have investment to be 180 and 170. PP will be what? I've forgotten the PP figure.
580.
580. Okay.
Awareness.
Yes, yeah.
Oh, okay.
Can we move on?
Yeah.
Okay. So let's now pick their liabilities also one by one. So their inventory is 200. They don't have other current assets. They have liabilities of 180. So 201. 180. So we have 200. So inventory is 200. And they have liabilities of 180. Okay. So after knowing this subsidiary, what do? We do net assets for them also, isn't it? So you can do the net assets. We do the net asset for them also. So net assets we have at acquisition. Because me, I'm solving it like I'm in the exam hall. That's why I'm doing the net assets differently. You can, as soon as you do the net asset for the first one, you can bring the second one there under it. Or you can just do them combined. You can just do them combined. You put the first one here, you put the second one here. That is all. So let's have their share capital. The share capital will be 400. Will be 400. What about their retained earnings?
300.
300.
At acquisition.
At reporting.
Okay.
At reporting.
So at acquisition
is 185.
It's
85.
Okay, 185. Let's count to the other components of equity.
At reporting is 80.
Okay. At reporting is 80.
Is 30.
At acquisition is 30. Okay. So let's count to if they have any fair value adjustment there. If they have any fair value adjustment
Yes.
there.
Contingent.
Assets and liabilities, isn't it?
Yeah.
Okay. So this has not been recognized, but they were just disclosed. But what is going to happen is that at the reporting, at acquisition date, the parent will take everything, even its contingent asset, contingent liability, the parent will be paying for it. They will be paying for it, because if the contingent asset is finally settled, it is the parent that is going to enjoy the benefit of it. So we bring all those things, all the internally generated intangible assets. Even if the company is having a brand, we bring the brand into the books because the parent will be paying for it. Okay, so we bring our contingent assets and our contingent liabilities that we are not recognized. So let's come to the contingent assets and contingent what? Liabilities. So at acquisition, these figures we are only disclosed. So fair value of this we are equal to this one, except contingent asset and contingent liabilities disclosed in the financial statement of Mount Thornton at acquisition, which had a fair value of 20 and 25. So the asset has 20 and 20. This will be having 25 and what? 35. So what we do is they have given us a value at 31 December. That will now be the reporting figure. We assume that there is no other movement over there. So acquisition, the asset is 20, the liability is 25. At 31 December, this will now be what? 35. So we assume that from 31 December to the reporting date, there is no other movement over there. So that will still be the reporting figure. So you have to count your statement of financial position. Then you now take these particular things into consideration. So you can add a 35 over here because it was not recognized. Then you count your contingent assets. The contingent assets, then you now put it under this one because you don't know when it will be settled. We are not giving the time, and that will be 20. Okay, so we are done with that. Let's get to other issues. So the contingent assets, they were not.
Linus,
yeah, ma'am.
can you please come again with the contingent assets? Because I know that contingent assets are not being recognized on the face of the financial statement.
That is in the books of the company itself. Now they are buying, you have a contingent asset, you have a court case which is currently over there, and you have an issue that the insurance company has to pay you, isn't it? Now, if you are disposing your company off, the company will no longer be your own. If the contingent asset has actually crystallized, are you coming back for the money, or the money will be given to the owner of the company now?
It will be given to the owner of the company.
Okay, so it means that the time that you are going to sell your company, you have to factor in what? The contingent asset. Because if it's actually settled, it is the new owner that is going to what? Benefit from it. So the new owner has to pay for it at all costs. But your own financial statement, you are not going to be what? Recognizing it. Are you okay?
Okay. Right. So that's why it's disclosed.
That is why you are going to disclose it in your books. But if you are selling, you factor it because you are not going to be the one to benefit if it has actually been paid.
Okay.
Are you okay?
Yes.
Whatever the subsidiary is not recognizing, as soon as the parent is going to buy them, they have to be recognized. Because it is assumed that it is part of the purchase consideration that the parent is paying for the shares that they are buying. Because whatever is going to happen, they will benefit from those things. So they have to pay for it. So it's part of the purchase consideration. So we have to bring all of them to books. Are you okay? Let's now count to this. Let's now count to the D. Snanik, D.
On April 2022, Jamasi purchased an investment property with, but before that, Linus, the 35 went to the liabilities, right?
Yes, please. Yes, please.
Okay. On 1st April 2022, Jamasi purchased an investment property with useful life of 30 years for 600 million cedis and rented out to Aguna on same date for 4 million per month till 31st December 2022. The property was carried in Jamasi's books at fair value of 650 million on 30th June 2022. Rent for the month of June 2022 was unpaid at 30th June 2022.
Okay. What are they talking about over here? They are talking about investment property, isn't it?
Yes.
Did we do investment property for this city?
Okay.
Did we do investment property for this city?
Me too,
I've forgotten all the things that we did. But
No, sir. We didn't do it.
no, we did investment property. It was only inventory that we didn't do. Yeah, we did investment property and solve the last sitting question for those FRP.
We did.
Yes, and I mentioned what qualifies the investment property. I said that if you are renting to your own employees, the parent is renting to a subsidiary, those are not what investment property. They should be accounted for as a PPE. Okay.
Yeah.
All right. What you have to know is that you have a company, you have a building somewhere. Now your branch is not having a place, and you are asking them that they should move into what? That particular building. Who is using the building? You have a head office in Accra here, and you have a building in Kumasi that is just there. Nobody is using it. But you have a branch in Kumasi that you are paying rent for. But you are saying, okay, since that particular building is there, nobody is using it, the branch should move into that particular building. That building, who is using it indirectly?
It's you, the parent.
It is the parent. So it is the building is still used by the what? The company itself. But in your separate financial statement, the parent will be preparing or will be classifying this particular investment as what? Investment property. And the subsidiary will also be what? Be paying rent for it, because in their separate financial statement, they will account for it using the specific standards. But if you are coming to the group level, where you are going to see the two companies as a one company, the building is still used by the group, which is the subsidiary. So the parent is using the building through the subsidiary, or the subsidiary is using the building on behalf of the parent. This can never be an investment property, because the building is still used by the parent, which is the subsidiary. This must be accounted for as PPE, not investment property. So whatever transaction that has been recognized in their separate financial statement must be reversed. And now we account for this particular transaction as PPE. So let's now come here. How was this particular transaction recognized? Let's come. Jamasi purchased this particular investment property at what? 600, with a useful life of what? 30 years. Okay. The property was acquired on what? 1st April, and was rented out to Agona on the same date for 4 million per month. Okay. How many months has the Agona used the building? The building has been used for how many months?
9 months.
4 months.
3 months.
It's 3 months, isn't it?
Yeah, 3 months.
Yes. So they're supposed to what? Charge, because they are using this particular, it will be used as operating lease. So whenever they pay the rentals, they will take it to profit or loss. So how much has been charged to their profit for this particular year in case of these rentals?
12 million.
It was 12 million, isn't it? And this 12 million has been taken away from what? Their profit. Are you okay? This 12 million has been taken away from their profit. So we go and reverse that particular amount. So we go here, we go to the retained earnings of Agona. So we have the lease rent tax, which will be, it is taken for the profit. So that will be, we reverse the what? We reverse the 12 million by adding it here. So that should be here. Okay. Let's now come to the parent will also receive what? The parent will recognize a rental income of how much? The parent will recognize a rental income of how much?
12.
12.
So we go there and take the reversal of the rental income, reversal of the rental income. So that will also be reversed. So we come and take the 12 over here. Okay. The parent is going to be recognizing what? A gain on what? Fair value gain on the investment property because it is 600, but they have 650. They have what? 650. The investment property is supposed to be 600, but they have 650. So the gain of 50 has been recognized to what? Profit or loss. So what we do now is what? We also have to reversal.
Talana, please, how did you get a 12?
The 12 is, okay, let me write the 50 and explain. The rentals is 4 million, isn't it? The rentals is 4 million
Yes.
per month. Okay. It's 4 million per month.
Okay.
And
Yes.
the building was given to them on 1st April.
1st April. Yeah.
And the reporting date is 30th June 2022. So from April to June is 3 months.
Okay, okay.
So that will give us the 12 million. Okay. But the question is that they have paid only 12 months rent, isn't it? They have paid only 12 months rent. Is that the case? They have paid only 2 months rent. Okay. They have paid only 2 months rent. Are we on the same side? Rent for the month of June was unpaid at 30th June 2022. So it means that they have paid only what?
2 months.
2 months. Okay. So they are owing them how many months?
1 month.
1.
Which will be 4 million, isn't it?
Yeah.
Okay. In the other current asset of the parent, they will be having receivable relating to the renters for 4 million. In the liabilities of the subsidiary, they will be having what? The renters owings of 4 million. We have to cancel them. This is intra-group balances. You can't be owing yourselves. So we go there and cancel these intra-group balances because we are going to be having owings of liabilities will be 4 million. Other current assets will also be 4 million. All right. So having canceled all of this, what we have to do now is that we now have to bring the property to what? PPE what? Form. So we have to account for this particular property as PPE. We have removed everything from the investment property. So this must be reduced by 50 also. So now we have, or we take the 650 over here because the property must be classified as PPE. So we remove all the 650 over here and add 600 here. Okay. Then what we do now is this particular property must be accounted for as a PPE. So if it is accounted for PPE, we have to charge a depreciation for how many months? If it is accounted for, are you sure?
3 months.
3 months.
3 months. Okay. But who is using the property? So who
is using it.
So who should bear the depreciation?
Jamasi should be.
Hey, it is the subsidiary who is using the property.
So the subsidiary should bear the depreciation.
The subsidiary is supposed to bear the depreciation because it is their profit that their property will be used to generate what? That particular. So the property will be generating benefit to them, not the parents. All right. So we count to the depreciation on that, which will be 600 over 30 multiplied by 3 over 12. What are we getting?
Five.
I'm having 5. And this 5 will be at reporting, isn't it? Okay. It means that investment property, this particular property must reduce by 5. The depreciation must reduce it. That is how we go about it. You reverse everything which has been accounted for under investment property and now account for your property as PP by depreciating it. That's how we go about it. All right. let's go to the next footnote. Let's kill it. Then we move on. The E.
So Linus.
Yes, Finia.
Please, the depreciation, you will record it under the net assets of Aguna as well.
Yeah, I've done that.
Okay. All right.
I've done that.
Thank you.
During the year ended 30th of June.
During the year.
During the year ended 30th of June 2022, Mampontin made sales of 50 million to Jamasi at 25% above cost. 60% of these goods were sold by Jamasi during the year. As at 30th June 2022, Mampontin has receivable of Jamasi of 25 million.
Okay, so this is what? Intra-group trading. Okay, since you are doing only profit or loss, since you are doing only statement of financial position, our focus should always be about the provision for unrealized profits. Okay, what was the total number of goods? Total amount of goods sold to the parent?
Million.
It was 50 million. Okay, but 40% of it were, 60% of these goods were sold, and 40% were what? 40% will be
unsold.
Okay.
Remaining.
So let's find the portion of the unsold goods.
20.
That will be 20 million,
That's
isn't it?
20.
Yeah.
Okay.
Yeah.
Okay. Okay. Can you sell to yourself?
No.
And you can see that the goods are still within the group, isn't it?
Yes.
Okay.
Yeah.
If the goods are still within the group, the IS2 is saying that inventory should be carried at lower of the cost or its what?
Realizable value.
Net realizable value. Okay. So what we'll do now is the net realizable value is 20 million. What will be the cost now? What will be the cost? The cost will be this particular 50. Now, this particular 50 over here is selling price. Okay.
Yes.
And the 25% is markup. Above
Yes.
cost is markup. So we don't apply markup on sales. We apply margin on what? On sales. So we have to change the markup to what? To margin. So let's go and do that particular. So Mampontin is the one selling. So they are going to be having the unrealized profits here. Okay. So the provision for unrealized profits. Okay. So let's look for the workings on that. So provision for unrealized profits be equal to 40% of the goods that were sold, 50, multiplied by the margin. So whatever you have to do is that margin must be lower than what? The markup. So if markup is 25%, automatically margin will be 20%. Or you can just do 25 over 100 plus 25. So the down, you add the top to the down. Okay, so you'll be having 25 over 125. That will give you 20%. So you have 1 over 5. What are we having?
20.
4.
That will give us 4, isn't it?
4.
Okay.
Yeah.
Okay. So it means that the profit element on the goods is what? Is 4, isn't it?
Okay. Yes.
But the net, so it means that the cost price of the goods are supposed to be 16. The cost price of the goods are supposed to be 16. But the parent will be carrying it at what? At 20 million. It is not the parent fault. It is the profit that is on the goods. So it means that 4 million of the profit will not be realized because the goods are not sold yet. So you count to provision for unrealized profits. You take the 4 million from the net asset of the person that is selling. If it is the parent that is selling, the parent will take it to their retained earnings because the unrealized profit is included in the retained earnings. What you do now is that since the goods are still within the group, the goods supposed to be carried at cost price. But Jamasi is having 20 over there. The 20 is the what? The selling price of the goods. So the goods, since the goods are still within the group, the parent is selling on behalf of the subsidiary, the goods must be carried at what? At cost price, not the net realizable value. So we subtract the profit element from the inventory because they already have 20 over there. So the basic way of going about this thing is that what is the portion of the goods remaining? Find the unrealized profit on it by applying the margin or the markup on the what? On the goods that are unsold. Okay, the profit over here, which is the unrealized profit, take it from inventory and also take it from the person or the profit of the person who is selling. That is all. That's how you go about it. All right, let's go to the let's go to the F. Let's go to the F.
Hello, Linus.
Yes,
Linus.
Please, that particular statement, we haven't finished. The E.
Okay.
Mampontin has receivable with Jamasi of 25 million.
Okay. So
intra-group transactions.
What assumption are you going to make over here?
And because they are intra-group transactions, they can't owe themselves. So it should be subtracted from both the current liabilities and the current assets.
Okay. The question didn't say that this has agreed with the what? With the payables in the liabilities of that particular, the other company. But you should assume that since they are having receivables, those people will also be assuming that they have what? They have the same value of the payables.
Okay.
Okay. So they always have to tell you that this agreed or this has agreed with what? With the corresponding payables over there. But
okay.
If this has not agreed, they will tell you that there is a goods in transit, and the difference will be due to the goods in transit. Or maybe cash in transit. Okay. So since nothing was said, we assume that it is the same as this one. So we have other current assets. We take the 25 over here. Then we come to liabilities. We take the 25 with the assumption that the two differences are the same. The two balances are the same. Sometimes they will not be the same. They can tell you that the 25 is a receivables of Jamasi, Mampontin, but this has not agreed with the corresponding payables in Jamasi due to a cash payment of this amount made by what? Jamasi on this day, which is yet to be received by Mampontin, or Mampontin has invoiced certain amount of goods to what? Jamasi, which is yet to be received. So the difference will be caused by maybe the goods in transit or the cash in transit. You just have to pay attention to it and adjust it.
Okay.
All right.
Thank you.
Let's come to the F.
In January 2022, Mampontin sold a machine to Jamasi for 55 million at a gain of 10 million. The remaining useful life of the machine at the time of disposal was 5 years.
The question is, can you sell an asset to your own company?
No.
No, you are just giving the asset to them to use because you are not using it. So the asset is still, the usage of the asset is still within the group. It's just like you have 2 motorbikes over here and at the branch in Kumasi, they don't have, but you are using only one. So you can say, oh, people should come and take what? This particular motorbike that we are not using over here. So you can ask them that they should come and take the motorbike that you are not using over here. But you are saying that, okay, since the two of you are keeping separate records, you will be saying that, okay, you are selling this to them at fair value. You are not actually selling to them. You are not going to take cash. Even if you are taking cash, it's just like you are taking cash from the company because you don't have cash over here. But since we are keeping separate records, what will happen is that the parent will assume that, okay, they are transferring the motorbike to these people at fair value. So therefore, we are going to be having a gain of this particular amount. Those people will also recognize the machine at the fair value and depreciate it based on the fair value. In actual sense, you are giving the machine to your own company. If you are giving your machine to your own company, the assumption is that the company is using default model for what? The accounting for what? The property, plant, and equipment, which is a cost model. What you have to understand about the transfer of PPE to the subsidiary or to the parent is that it is assumed that they are using the cost model of accounting. If you are using cost model, it means that whatever you are going to transfer to your subsidiary or your parent or your branch, it must be transferred at carrying value, because we are using what? Cost model. We don't have to what? Fair value before we transfer the asset. So this particular question will be assumed that the parent is using what? Cost model. But what if the parent is using revaluation model? It means that the parent must transfer the asset at fair value. They have to first fair value the asset or revalue the asset before they transfer. In this particular case, we don't have any issue because the asset should be transferred at fair value because the company is using what? Fair value model for accounting. But it is always assumed that the company is using cost model. Whoever is transferring, the person is using cost model. If you're using cost model and you want to give something that you are not using to your brother, it should be given to the amount that you have now. If you are going to sell it 5,000 or the value of the shirt now is 5,000, give it to your brother at 5,000 because you are the same person. So the asset must be transferred at the carrying value. The question now is, what's supposed to be the carrying value of the assets at the date of the transfer? What's supposed to be the carrying value of the assets?
45 million.
45 million.
Okay, so the assets should be transferred at 45 million, meaning that the parent should not have any gain on this one. So we have provision for unrealized profit on PPE. They should not have any gain. This particular gain must be reduced.
It's the other way around.
Who is transferring?
The subsidiary is selling to the parent.
Okay, it is the sub. Okay, hey, my point, you are doing it too. Okay, so is the subsidiary, which is the Mampontin, isn't it? Okay, so let's come to Mampontin over here. So the provision for unrealized profits has to be 2 for Mampontin. One will be for the inventory, one will be for the property, plant, and equipment. So they have a gain of 10 million here. Okay, they have a gain of 10 million there. What is going to happen? The assets should be transferred at 45 million, isn't it? The assets supposed to be transferred at 45 million. Is that correct?
Yeah, that's correct.
But in the financial statement of the parents, what are they having there? The asset was carried at 55 million, isn't it?
Yeah.
So we must first reduce the asset to the 45 million. The assumption is that the PP will be added over here. Okay, the PP will be added over here. Or we also have another way of going about this one. So the PP will be added over here, and the 55 is included over here. So let's subtract the 10 to now make it 45. Then there's something that we are going to do again.
Depreciation.
Exactly.
Depreciation.
Exactly. So there will be an issue with excess depreciation. Okay, let's come here. We all agree that the assets are supposed to be what? Transferred at what? Carrying value. The assets are supposed to be given to them at carrying value. If the asset is given to them at carrying value, it means that, or if it is the parent who is still using the asset, the parent is going to be charging a depreciation of 45 million over the remaining useful life. Over the remaining useful life of what? 5 years. Over the remaining useful life of 5 years, multiplied by 6 months. Am I correct?
Yeah.
Because the asset was transferred on January 1. Okay. So what's supposed to be the depreciation under this? I'm getting 4.5.
Is that correct?
Yeah, that's correct. 4.5.
What was the depreciation charged by the subsidiary? They charge a depreciation on the 55 over 5 times 6. Do we agree?
5.5.
The depreciation was charged on the what? On the fair value given to them for 6 months.
Yeah.
Okay. So that would be 5.5, isn't it?
Yeah.
Okay. Assuming the asset was carried at carrying value, the carrying value would have been 40 40.5, isn't it?
Yeah.
Okay. But this value is now what? The carrying value for these people will now be 49 point what? Okay. This will be 45 minus 4.5. That will be 40.5 and 55 minus what? 55 minus 5.5. I'm getting 49 point what? 49.5. Okay. So the value that should be recognized in the assets supposed to be 40.5. But how much was recognized?
49.5.
49 point what?
5.
Okay.
And
49.
you've taken 10 already.
Yes. So 49.5. Okay. So I've taken 10 already. It means that I have only the value that was there was what? 49.5. But I've taken 10 already. So it means that they have 39.5, isn't it?
Yes.
So what value should I go and add to make it 40.5?
1.
It means that you just
One.
put the excess depreciation here. What was the depreciation charge in excess by the parents?
1.
It is 1. So what we'll do is that you go and reverse. It is the parents. So you count to the excess depreciation over
It's
there.
1.
The depreciation that should be charged by the parents. The depreciation that should be charged by the parent should be 4.5, not 5.5. So they have charged this one in excess. So you add the one back because they're supposed to charge 4.5, but they have charged 5.5. Okay. Let's come to this one. We'll come and add what? 1 over here. Okay. Another way of going about this particular issue is this one. You see, you can decide not to subtract the 10 and add the 1. You just ask yourself, okay, the asset should have been having a value of what? 40.5 in the PPE, but it is now 49.5. What is the difference? The carrying value, the actual carrying value should have been
9.
40.5. Okay. The difference is 9. Okay. Can you agree that negative 10 plus 1 is 9?
Yeah.
Yes. So you can decide to come and subtract maybe the 9 over there. You have increased the value by 9. That particular 9 is the same as the negative 10 plus 1, which is the 9, which is the minus 9. Okay. So anyhow you want to go about it. If you have a transaction like this, you always have to know that the asset should be given to the subsidiary at carrying value. If it is given to the subsidiary at carrying value, what should have been the actual depreciation? Or you just assume that the subsidiary or the parent is still using the asset. So they will be using the asset at the carrying value. What should have been the depreciation? The depreciation should have been 4.5. But what was the depreciation charged by the subsidiary or the parent or the person who received the asset? It is 5.5. Instead of them charging 4.5, they have charged 5.5. It means that they have overcharged their depreciation by 1, which have reduced their profit. So go and add the 1 back to the profit. Then you also adjust the what? The asset. The asset should have been carried at the original carrying value. But what is the carrying value now? What is the excess amount added? Go and subtract it from the PPE. You are good to go. That is all. All right. Let's come to the gym part. Okay. Okay, we have the additional 2 footnotes to move on. Okay.
Jamasi measures non-controlling interest in Aguna at fair value, but measures non-controlling interest in Mampontin at proportionate share of net asset.
Okay. So let's now put our net asset together. Let's put our net asset together and now have the net asset at acquisition so that we can go ahead and so can we do purchase consideration for Aguna? So let's Aguna, we have the Aguna already. We can do for what? Mampontin. So let's count to Mampontin over here. We have there. So let's add the NCI. We have to calculate the goodwill using fair value method. So let's add the NCI for these people. Agona is 340. So what will be the total value? What will be the total value?
1263.
1263.
126. 1263. Okay. Let's now find the net asset for them. What is their net asset at acquisition and also at reporting? I'm having 119.
Yeah, 1119.
Okay. What about at acquisition? At reporting rather, 510 plus 200 plus 30 plus 19 plus 12 minus 8. I'm having 1406. Can someone confirm that?
I'm having 1413.
Okay, let's
Yeah,
check.
I'm also having 1413.
Okay, so let me find a good year first before we resolve that particular issue. Okay, so 650 plus 510 plus 200 plus 30 plus 19 plus 12 minus 8. Okay, 1413. Okay. What is the difference?
$294.
29.
Four.
Okay, that particular 294 is not entirely what? It's not entirely the post-acquisition profit. Included in that 294, there is 80 that is relating to what? Other component of equity. Do we agree? There is 80 that is relating to other component of equity. So we are going to be splitting that particular 294 to other components of equity and the retained earnings. So let me just put the NCA here and have the fair value at acquisition. That will be 340. Okay, so that post-acquisition profit, we are going to be having other components of 80. Okay, why 80? That is a movement in the other component of equity. Okay, 80. So the retained earnings, actual retained earnings will be 114. Is that correct?
214.
Okay. Okay, it's 294. Sorry. So that will give us 214. Okay. You see, you can also find a post-acquisition profit like this.
Linus, please come again.
All right, let me come here again. Look at this. You can see that the 294 that we are having over here is we subtracting the total net asset at reporting from the total net assets at acquisition, isn't it?
Oh, yes.
All right. Look at the movement in the retained earnings. The retained earnings is having what? The movement over here is what? Is 210, isn't it?
210, yes.
The movement in the other component of equity is what?
80.
Okay. So you can see that we have added a movement. We have added a movement in the retained earnings and other component of equity together to get a 294.
Okay.
So the 80, which is relating to other components of equity, must be separated from the 294.
Okay.
Another way of you finding the retained earnings is that you take your 210. That is before any adjustment, isn't it?
Mm-hmm.
Okay. You should be taking depreciation of 3 million. It has not been taken. Okay, you should be taking a depreciation of 3 million. It's supposed not. It has not been taken. You have charged a rentals of 12 million to your profit or loss. Now we are reversing it. That this particular one will also increase it. You are using a property which the parent is saying that investment property, now it is accounted for as PP. You should be what? Depreciating 5 million every year. So now find
Okay.
your retained earnings now. So we have 210 minus 3 plus 12 minus 5. What are you having?
214.
214. So you just have to find which portion of the post-acquisition item, which is the 294, which of them is relating to retained earnings, and which of them is relating to what? Other component of equity. You can only share the 294 if the parent is not keeping other components of equity. So you take all of them to retained earnings. If the parent is having other components of equity, it means that take their share of the retained earnings, which is the profit, to their retained earnings, take their share of other components of equity to their other components of equity. But whatever be the case, the NCI will be having the share of the 294 because they will have the share of the profits and they will have the share of what? Of the other components of equity. So if you come to the NCI over here, they'll have their share of post-acquisition, which will be 0.4 multiplied by 294. NCA will have the share of the total amount. I'm having 117.6.
Correct.
Okay. Let's go to the retained earnings. We have the share of post-acquisition profit. That will be Aguna. So the parent will have 0.6 times 214. What are we having?
128.4.
128.4.
Okay. So you take their share of other components of equity to this particular one. So this will be 0.6 times 80. Okay.
48.
Okay. So you can do it and add a 48, or you can just come and do the calculation there. So let's go to the goodwill for this particular people. 1263 minus 1119. I'm having 144. Okay. That is a goodwill at
Yes,
acquisition.
please.
That is a goodwill at acquisition. Let's look at the net asset for Mamponten at acquisition and also at reporting, because there is no items that will be coming there again. I'm having 580. Is the 550 correct?
16.
I have 580. Is it correct?
I'm having 16.
For acquisition?
Yes.
Okay, let me do it again.
Yes, 16.
5 plus 185 plus 30 plus 20 minus 25. Okay, 610.
Yeah.
So how come? I already added 30. So that will be 610. Okay, let's come to reporting. Is what?
751.
Okay, the difference is what?
41.
40.
141. It's 751.
751. Okay. 751. Okay. The difference will be
141.
okay. That 141, it is not entirely post-acquisition profit, isn't it? Okay.
Yes.
50 of it
Yeah.
is for other components of equity, and the remaining 91 will be for what? Post-acquisition profit. So let's count to the share of the post-acquisition profits, which will be Mamponten. This one, the parent is having 70%, 0.7 times the 91. What are we having? I'm having 63.7.
3.7.
Okay. So let's go and do the NCF for these people. Okay. This one, I can put the two NCF over here together. You can put them together and have the total NCI. So let's put these people, their NCI over here. 340 plus 117.6. I'm having 457.6. So this will be Argo 9. And let's come to Mamponting. So the fair value for Mamponting will be 0.3 because they are using proportionate method. So 0.3 times the net asset, 610. What are we having?
$183.
Okay. So that will be 183. So they will have their share of what? The post-acquisition profit, which will be 0.3 times 141. The NCA will have the share of the total, but the parent will now split its own share. So we have here, you have 0.7 times the 50. Okay. So you come here. What are we having? The 0.3 times 141. I'm having
42.3.
okay, 42.3.
Yeah.
Is there anything that we have to do again? We share all the profits already. So we have to calculate goodwill on what? Goodwill on acquisition of what? Mamponten.
9.2.
Okay, let's calculate the goodwill. We start with the purchase consideration. Okay, the purchase consideration, we paid 450, isn't it? Okay.
Yes.
We just look for the net assets. What is the portion of the net asset that we are buying? 0.7 times 610. How much are we having?
$427.
Okay, so what is the goodwill?
$23.
Okay, so let's
23.
take the FANA. Let's take
Hello,
the
sir.
yes, yeah.
So with this one, won't add any NCI value to it?
You can add the NCI, but you use all the system, you'll be getting the same answer. But because I don't have space there, so you can add the NCI of 183. So add 450 plus 183, then minus all the 610. What are you getting?
They said Agnes goodwill was impaired. Though.
Yes, we will take the last footnote, but I want him to confirm the calculation. Deborah, what are you getting? $450 plus 183. Then you subtract 610, the total of the 610.
The 450 plus the 183 is 633.
Okay, minus 610, which is the total value of the net assets.
23.
Okay. I can also calculate the goodwill for Agona. What I will do is that I will have 119 over here. Then I will subtract 340 over here because this is the total value of the company, which is for the parent and then the NCI. If NCI is 340, what is the portion that the parent will be buying? So I won't bring the NCI over here. I'm adding the NCI over here because the NCI is part of this one already. So instead of me subtracting the NCI from this figure before I comparing it with the amount that the parent is buying, let me just add it because the NCA over is already over here. So the NCA is the 340 is part of the 119, and you are adding it. If you subtract, it will be having the same effects. So I can decide to subtract the 340 over here. Then I will compare this figure to the resulting amounts. I will still be getting 144. So 780 plus 143. Then I'm having 923. So 923 minus what? The 119 minus 340. You'll be getting 144 as the answer again. We only add the NCA because the NCA is already part of the total net assets. We should subtract before comparing to the amount that the parent is paying. But since we are not subtracting, let's just add it so that if you subtract, it will be zero effect. Deborah, are you okay?
Yes, sir. Thank you.
Okay. So the goodwill over here is 23. The total goodwill is 144 plus 23. But let's take the last footnote before we consolidate everything. Okay. The goodwill arising
from
okay, Senior, go ahead.
the goodwill arising from acquisition of Agona was impairment tested. The recoverable value of goodwill estimated at the date was 1,495 million. There has been no impairment in Mount Ponteen's goodwill since.
Okay. So the goodwill arising from acquisition was impairment tested. Okay, the recoverable value of Agona estimated at this date was what? 1495. So what they are talking about over here is at reporting date, they have done the impairment on this. Let's go to the net asset of Agona. What is their net asset at reporting? Their net asset at reporting is 1,413, isn't it?
Yes.
Okay. So let's look at impairment test of goodwill. Impairment test. So we look at the net asset at reporting. Is 1,413. But you have to know that this net asset is excluding what? Goodwill. We have done all the adjustments, the fair value adjustment, everything has been taken into consideration because before we have gotten this particular 1,413. Sometimes they will give you the net asset at reporting, which they will say net asset before any adjustment on consolidation. It means that fair value and those things are not part of it. So you have to now add the fair value adjustment, the goodwill and everything. So let's add the goodwill now to know the total value of the net asset. The goodwill is 144. What are we having? So 1,413 plus 144. I'm having 1557. That is the total value of this one. So they are saying that the recoverable amount is how much?
1,495.
Okay, 1495. What is the difference? Is it 62?
Yeah, 62.
Okay. So this particular 62 will be relating to what? Goodwill, because the goodwill is 144. So the 62 is relating to the goodwill. Assuming the impairment is 160, goodwill will take 144, and the remaining 16 will be given to PPE or any other asset. The question will tell you which of the assets will be taking the remaining one. But since it's 62, it can be taken by the goodwill. So it means that the goodwill has impaired by what? By 62. So the total goodwill, let's go to statement of financial position. The total goodwill will be 144 plus the 23 minus the impairment of 62. That is the total goodwill. This impairment will be shared among the NCI and the parent. So I can now bring my NCI to the top here. So I can have my NCI to the top here, which is Argo 9. Okay. So I'll have my fair value to be 340, and I'll have the share of impairment because they are using what? Fair value for the NCI. So the impairment will be 0.4 times the 62. What are we having? I'm having 24.8. Okay, so let's now find our total value now. I'm having 432.8. Is that correct? Can someone confirm that for me?
Yes, confirmed.
Okay, so this will be 225.3. So you put the two ends here together. Let's count to the parent group retainers. We have the share of impairment over here. So that will give us 0.6 times 62. What are we having? I'm having 37.2. Let's find the total amount now. 930 minus 90 minus 50 plus 1 plus 128.4 plus 63.7 minus 37.2. I'm having 10106.9. Can someone confirm that?
Yes, confirmed.
Okay. So can we move on now? Can we send these figures to? So statement return earnings is 1016. So this will be, you can put it working 6. So you have your 1016.9. Let's put our share capital together. That will be 21x0. Let's count to other component of equity. What will be the total amount? Other component of equity, 0.6 times 80, 48, 0.7 times 50, 48 plus 750. I'm having 833.
833.
Okay, let's now have the NCI. The NCI, let's assume that it's working 5. The NCI, you put the two together. Okay, so let's put the two together. 432. So 432.8 plus 225.3. I'm having 658.1. So NCI will be 658.1. Okay, let's put our liabilities together. 450 plus 240 plus 150 plus 180 plus 35 minus 4 minus 25. I'm having 1026. Well, let's put the two together. 2180 plus 1016.9 plus 833. 429.9 plus 658.1 plus 1026. I'm having 5714. Let's count to this.
14.
Okay, we have 34 here. Then the other current assets, we are going to be having 360 plus 260 minus 29. That will give us 591. 591. Okay, so let's go and put these ones together. So we have 490 plus 3310 plus 200 minus 4. So having 1016. So contingent asset will be 20. Investment will be 350. Goodwill will be how much? 144 plus 23 minus 62. That will give us 105. The investment property will be dash. Then we now have 15 A0 plus 840 plus 30 minus 18 plus 580 plus 600 minus 15 plus 1. I'm having 36, 34. Can we confirm that? 105 plus 370. Can someone confirm the 36, 34?
I'm having 3603.
36.
03.
Okay. Hey, so how come? 1580 plus 840 plus 30 minus 18 minus 18 plus 580 plus 600 minus 5 minus 10 plus 1. Hey, I'm still getting different figure. 3598.
I'm still getting 3603.
Let me check again. 1580 plus 840 plus 30 plus 30 minus 18.
Where is your 5 coming from? I don't have 5.
The minus 5
Yeah.
is a depreciation on the investment property.
I thought we had 1.
No. The transfer, it is a transfer that they are having excess depreciation of 1.
And the building.
Yeah, the one that they are having the least property that we are accounting for it under PPE.
Yeah.
Yeah, that is a 5. So
Okay, let me
plus
see what
600 minus 15. Plus
So I have 3598 now.
okay, 3598. Okay. So 3598.
Yeah, confirmed.
105 plus 350 plus 20. The total is 4073 for the non-current asset. 4073 plus 1016 plus 591 plus 34. Okay. 5014. All right. Senior, that is all about this one. Let's see whether we can solve the cash flow. It's very important.
Hello, Linus.
Yes, senior.
Though our 10 balance, I'm having some challenges.
Okay.
My network was messing up, so the footnote D.
Okay.
You see, the 12 that we had had some 12.
Yes, please.
I'm not getting it. And also the what do you call it? The depreciation on the property.
Yes,
I
please.
think it should be against Jamasi, because it seems now it's like owner occupied. Jamasi, Aguna is renting. Aguna is a group member. So it has become owner occupied. And the owner is the Jamasi. So the rent, the depreciation should be taken care of by Jamasi, who is the owner of the property now.
Jamasi has always been the owner of the property. It is
Yes, Jamasi has always been the owner of the property.
Why do you think it is owner occupied and Jamasi have to take the depreciation? It is owner occupied because it's a subsidiary that is occupying it.
Yes, so the depreciation should be against the ultimate owner.
Who is benefiting?
The depreciation should be against the ultimate owner.
Who is benefiting from
the property? Jamasi, the group. Please come again.
Who is benefiting from the property?
Who is
benefiting from the property?
Both are benefiting.
Both. Okay. Explain why you say both.
Both are benefiting.
Okay.
Aguna is benefiting from using it. Jamasi is also benefiting from receiving renters.
No,
so both are benefiting.
We are canceling the renters now.
Okay. Yes. So if we cancel the renter, the more reason we took up the 650 from the investment property is to make it an owner occupy, which is a PPE now.
And the owner is not the parent itself that is occupying. So the revenue.
No, but we assume that's why we are changing it. That's why we are eliminating it from the books.
We are not assuming that it's the owner. We are doing it at the group level. If it is at the group level, the subsidiary is part of the parent. So the subsidiary is occupying the property on behalf of the parent. So we can't rent to our own company.
But
yes, we can rent to our own company. That's why it is the parent who is supposed to suffer the depreciation.
So the parents will charge the depreciation.
Yes, not the subsidiary.
So the parents should still charge the depreciation.
Yes, please.
Even if the property is not generating any direct income, any income that will be coming from the property will be what? Will be to the subsidiary. So what portion? Anytime we use the building to generate revenue, what portion of the building are we using to generate that particular revenue?
Matching concept.
Yes, so we are so now it is in the name of the group. We are doing it for the group. Jamasi is the owner. Jamasi, we are seeing ourselves as one people. So Jamasi
is the owner. Okay.
No, I think it's a subsidiary because
why is it that the Maponten has transferred property to Jamasi, but the depreciation was borne by Jamasi, not Maponten. Look at the
Please, F. Which one?
Look at the F.
The F.
Yes.
Uh-huh.
So Maponten sold a machine. They are not selling.
So the F is an outright sale.
It's at acquisition. It wasn't not.
No. It's not acquisition. Why? If it is an acquisition, why are you bringing it to the carrying value?
Not that one. They are selling the property, the machine.
They are not selling. They are just transferring it, but they assume that they are selling at the fair value. So they will recognize.
Yes, exactly.
Yes. But since we are one group, you can't sell to yourself. So you are just transferring the property to them. So the property is now owner occupied. You are just transferring it to them, not yourself. Whoever is using the property must bear the depreciation because they are generating the direct revenue from that place. The parents don't get any revenue from that particular property because they are not using it. They are not the one occupying it. Though it is owner occupied, but who is occupying it? It is part of the parent, which is a subsidiary. That makes it the owner occupied. So this is just a matching.
But Linus, but we are preparing the account in the name of the group.
Where we are consolidating the items of the two companies.
Yes. So, for instance, in the separate books of Maponten can record depreciation. But now that we are preparing it for the group, the mother should suffer it so that other what do you call it? The NCI of these people will not suffer anything.
Oh, why? Why they will not suffer?
Because
So
it's affecting.
no, but they are using the same property to generate revenue. Why will you take your 100% portion of the revenue without bearing the cost that is incurred to generate the revenue? Agona is the one who's going to use the property. Okay.
Yes.
But first they are paying renters. Now we say that don't pay renters. So we are going to reverse the renters. Okay. Now don't pay the renters. Use the property now. So it means that you will be depreciating the property. The property is now for you. You are now using it. So the reason why we are saying that it is owner occupied is that the property is occupied by what? A subsidiary, which is what? A part of the parent. So it is not the subsidiary that is occupying it. But who is enjoying the benefits associated with the property? It is the subsidiary. So whatever revenue that the property is giving to them, they must match the cost that they incurred. And that particular cost is the depreciation. So if you are giving a depreciation to the parent is not getting any return directly from the property. They are not using the property for their own operations. No. It is the subsidiary that is using the property. So instead of the rent that they are going to be paying, we reverse the rent, then they will now bear the depreciation on the property. So the parents don't have to, although it is owner occupied, but the parent don't have to what? The parent doesn't have to bear the depreciation because they are not benefiting in that. They're not benefiting directly from the usage of what? The property. Whoever is using the property, the person must what? Must bear the cost. You can't give me a car and I'll be expecting you to come and buy the fuel for me again. No. Okay. I have to buy the fuel myself. Okay. Senior.
So, the investment property coming under the parent in the financial statement, is that not a signal that the parent is
it is in their separate books. You can see that they have given us their separate financial statements.
Yeah.
Okay. So the 658 is in their separate books. In the separate books of the subsidiary, they are also paying the renters. So they have also recognized the renters. Okay. But this particular one, the parent is giving the assets on operating lease. The parent is giving the asset on operating lease. It means that the asset is still with them. Okay, but since we are now classifying the asset as PPE, now the parent is not the one using the asset now. So who is using the asset for administrative purpose now? It is the subsidiary. So the subsidiary has to bear the depreciation on the asset. The depreciation must be bear by whoever is benefiting from the asset directly.
Linus. Okay. Yes. So the question is, who is using the property? Who is using the facility as a PPE?
Who is using it?
Is it not the parent? The parent, that's the company, the entire group.
No, unless the subsidiary is not autonomous. That is why we say that the parent is doing everything for them. But the subsidiary is an independent subsidiary.
Okay.
It's an independent subsidiary. So they will occupy those things and bear all the costs on themselves. So we just bought the asset for you. Come and use it. That is all. So the depreciation should be bear by whoever is benefiting from the asset directly. That is all.
Assets.
Yeah.
Oh, okay.
It's just a matching concept. Very simple.
All right. Thank you.
It's an interesting one. Okay. But that particular one cannot take more than one mark if you are doing.
Oh yes, exactly.
Okay, so let's see whether we can finish the. Let's see whether we can try to finish the cash flow. Is also one of important one, and maybe we can. You see, it is we are all, but at least we have used this question to talk about a lot of issues. So let's look at the cash flow. Okay, the cash flow. What are the things that you have to do? The cash flow is just like the normal cash flow. At the end of every day, you have to reconcile. At the end of every day, you have to reconcile because the cash flow the statement given to you means that they have done the correct thing. You have to ask yourself, how was the correct thing done? So you just have to ask yourself, how was the closing figures arrived at? That is what we want to look at. The cash flow, we use the indirect method. Even if the question did not say anything, we use the indirect method. Okay, because the direct method is somehow very simple. So we use the indirect method. So we look at the question 2, which is the consolidated statement of cash flow. Okay. So we have the operating activities. So we have the operating activities. Then we start with profit before tax, but it should be after the share of. So the profit before tax, but it should be after the share of associate profits. So let's go and see what we are having there. So that's what we are having there. What are we having for this particular case? So we have profits for the year from what? Continuing what? Operations. Or if you like, you can take the profit for the year. Then you go and add the 33 back to it. But you have to take the profit from continuing operations. That is all. And the profit over there is what? 289. You can take the profit for the year, which is 322, because there is no issue of tax there. But it should be profit before tax, but it should be immediately after the share of what? Associate profit. So that will be 289. So let's take the 289. So our profit is. Yes, yeah.
Please go back. Let me.
Okay.
So the 241.
The 241 is the profit attributable to the owner of the parent, the parent, and this is 81. So I'm saying that you can take the 322. By then, you have to come and add the 33 to it again. Okay. So to be at the self, you just take the 289, which is the profit immediately after the share of what? The share of profit from equity accounted investees. That is the share of profit from associates. So you just take 289, then you come and subtract your 81 because this is not cash. We adjust the non-cash items against it. So what you do is you have your 289, then you add your finance cost to it. So your finance cost was 66, you put it here. Then the share of associate profit was an addition. So you subtract. Yeah. So that was 81. Let me see. Okay. So that was 81. So there's any.
Why are we bringing it here?
Why are we bringing it here?
Yeah.
Okay.
Okay. It was before the 289.
Yes, please. And it has been added, so we subtract. This is a profit, not cash. Okay. So there are certain items that we have to come in. Sometimes the question will give you the depreciation themselves. But sometimes they can also give you information that you have to use to calculate your depreciation. So we are going to ask ourselves how we can get other non-cash items. Okay, let's now come to the footnote. Let's come to the first footnote.
During the year, PL entered into an agreement with another entity to set up Capricorn Limited, a joint arrangement. PL has invested 100 million in form of cash and has a 40% right in the net assets of CL. This amount has not yet been utilized in CL's operation. Remains in the form of cash.
Okay, This is, you see, there are some parts of the consolidation that if they examine it, there will be a problem. Okay, those parts are the joint venture, interest in joint venture, which is the IS31, and the joint arrangement, which is the IFRS 11. Okay, but a joint venture, interest in joint venture, the standard says that even if you have 80% interest over there, it should be accounted for using equity method. So the way you account for investment in associates. But if you come to the joint operation, we use what we call the partial consideration. So if you're having 40%, you find the 40% of all the assets and liabilities, the income and all those things. Okay, before you add. So you can see that the final mock, there's a question on the joint venture over the joint operation and those ones there.
Yeah.
Yes, because we haven't done that standard. That is why I put it there so that I can use it to explain the accounting treatment for the joint. So you first have to ask yourself whether the investment is a joint venture. What do we call a joint venture? The joint venture will always involve in the establishment of a separate company or a different company apart from what the parents. So is going to result in independent company apart from the two companies. So they are going to set up a new company to run whatever they want to do. But if you come to joint operation, a joint operation can be maybe we just want to acquire an asset to run the operation, but it will not necessarily involve what establishment of a new company on its own. We need an asset for the operation, so let's buy the asset. I will contribute this amount of it. You also contribute this amount of it. Or also, we just rely on our expertise. Okay, this is what we want to do. Okay, I will use my existing assets to undertake 60% of the work. Okay, you also use your existing asset to undertake 40% of the work, or the work that we want to do. I have expertise in this part. I will take care of this one. You also take care of this one. That is mostly the joint operation, and this will always be on a separate vehicle. A separate vehicle can be we contribute money to buy an asset. That asset can be seen as a separate vehicle. We are not using our own asset, but we are using a different asset to run the operation. Whatever happens, you use partial consideration. You find your portion of the asset and liabilities, revenue, income, and expenses. That's how we go about it. So this particular one, you can see that it is going to be involving the establishment of a new entity, isn't it? So this will be accounted for as a joint venture, equity method. They are saying that this has not been used yet, but this is amounts that the company spent in the year. So there's a cash, which is an investment in associate of 100 million. It has been incurred during the year. So you go to your investing activity straightforward by bringing the cash over there because you have invested your cash into other activity. So you can come to investing activities over here. And the first item you have over there is that you have spent cash on investment in associates for the year. So you can say investment in associates, of 100 million. That is an outflow. So you put it over there. After knowing this, you can go straight forward to reconcile your investment in associates. So let's reconcile that. So let's come to maybe financing activities over there. If we get this one by one, then you bring them. So financing activities. So I just wish I can just divide these things into two. So that I'll be doing the workings here. So let me just put the 100 million here. Okay, so maybe I'll do it over here so that I can do some workings there. Okay, so let's now do the workings. So the workings, you'll be reconciling them one by one. Let's reconcile the investment in associates. How do we reconcile that? We are only looking for how the closing figure has been calculated. So let's look at how the closing figure has been calculated for the investment in the associates. So let's come to the investment in associates. The opening balance was what? The opening figure that we have was what? The opening figure is what?
124.
Okay. Yes. So we have balance brought down. 124. What is going to increase this? The share of the profit, isn't it?
Okay.
Okay. The share of the profit was how much? We have that already over here, which was 81. So the share of the profit is going to increase. What is going to increase this one already? Yes, Senior.
Please, can you, reduce the pace a bit? Because the way you.
Okay. Okay.
Before we bend, we read the question and raise that.
But there's something new.
Oh no, we have done cash flow already.
Oh, okay. Have you know my problem?
It's an opportunity. Like the financial position where when you start, you know this.
Okay.
You know,
The way they have even termed them.
You know.
Charlie.
Okay, so let's take the investment in associates. You take the opening balance, then you add so you just ask yourself, how did they get the 261 over here? How was it gotten? So if they take the opening balance, then they adjusted it against any movement during the year, which can be share of profits, it can be dividends, it can be impairments, it can be any additional investment over there. So they have 124. The only thing that is going to increase is the share of the profits. Okay, then we now ask ourselves, is there any other issues that happened during the year? Yes, we also have done additional investment. So there is additional investment, which is in the joint venture. It is still in cash. So we now add 100 over here. Okay, so the investment, which is the investment in the joint venture, will also be accounted for as equity investments. There's no profit yet. So we just add 100 to the investment that we have. So no other issues has happened. What should have been the supposed balance? What should have been the supposed balance? 124 plus
305.
Okay, that will be
305.
Okay. What is the actual balance?
261.
261.
What is the difference?
plus
44.
Okay.
44, yes.
This particular difference will be seen as a dividend received. Okay.
Okay.
So 44 will be seen as a dividend received. The actual balance or the supposed balance should have been 305, but we are now having 261. It means that they have paid a dividend to the parent, which is 44. Sometimes it can be dividend or it can be impairment. If nothing is being said, it is dividend. But if they say that the difference over there is an impairment, then it means that that is an impairment relating to the investment in associate. Then you go and add back to the profits. But this will be seen as dividends. So the parent has received a dividend received from the associate. That will be an investment. Dividend received from the associates. That will be a cash 44. Okay. Let's now go to the B. So this one, you have to be working with the footnotes. You have to be working with the footnotes. Okay. Let's look at the B.
During the year, property, plant, and equipment purchased by PL and its subsidiaries amounted to 69 million, 84 million respectively.
Okay.
Furthermore, one of the subsidiaries sold an equipment for 45 million, which had a carrying value of 56 million.
Okay. So you can see that there's an acquisition of new asset during the year, isn't it?
Yes.
Okay.
Okay.
Yeah.
What is the total amount?
One five
153.
Okay. Sometimes the question will give you depreciation and they will be expecting you to look for the acquisition of the new asset. But right now they are giving you acquisition of the new asset. They are asking you to look for depreciation. So sometimes this particular 153, you have to determine it yourself. They will give you the necessary items. They will give you the depreciation. They will give you the revaluation surplus. They will give you things that you have to reconcile your assets. Any difference between the supposed balance and then the actual balance will be the acquisition of what? of the asset. But now they have given us the acquisition, then we will be looking for the depreciation ourselves. Okay. So we have acquisition of PPE. That will be an outflow, isn't it?
Yes.
153. There was also a process from the disposal, isn't it?
Yes.
Okay. The process from disposal was what?
45.
That is that is inflow. Can we see that there was a loss on the disposal?
Yes.
Okay.
Yes.
The loss is how much?
11.
11.
Okay.
11.
Where this loss will be taken to?
The profit adjustment.
Okay. So it means that the loss has already been taken into consideration before they have gotten this particular profit. So you come and add back the loss on what?
Okay.
Disposal. Then you see, they have done everything. The statement given to you that they have done all the necessary correction.
So if it were again,
if it were again, you subtract.
Fine.
Oh, okay.
Yeah. If it's
if it's again, what happens?
You subtract. It means that again has been added to the 289. So you subtract because it's not a cash item. So it is not now that you are coming to adjust the footnote. They have done the adjustment for the footnote already. So you just have to come and ask yourself that if the adjustment was not done, what should have been the closing balances that I will be getting compared to the closing balances that they have given to you? Then you will not give name to the differences between your own closing balance with the one that they have. And that is how come we have the dividend receipt, because we have to determine the closing balance for the investment ourselves and compare with the investment that they have or the balance that they have. Any difference over there, they will not give it name. That's how we do about it.
Can we move very simple?
Okay.
Linus.
Senior.
And please, why is it that the share of associate profit, we are adjusting it here, and we also did an adjustment in the investing activities, that the joint arrangements?
Okay. The share of the profit, is included in the 289. Okay. This is profit, not cash. We are preparing cash flow statements. We bring only cash items over here. So it means that you see the profit we are using cash sales and credit sales, and we're also using cash purchases and credit purchases, isn't it? We just want to remove those credit items and those non-cash items so that we have our cash sales and also our cash purchases to have our cash item. So it means that even if we are using cash sales and cash purchases, there will be some non-cash item that is going to be reducing our actual cash. So those non-cash items will be subtracted or will be added. We just want to adjust it so that we have our actual cash. That is why we add it back. But the credit sales and the credit purchases, they are adjusted using the increase or the decrease in the working capital items. Those are the ones that is going to remove the credit purchases and the credit items in the actual cash. So you just do your adjustment and bring it over here. It's just a normal cash flow, but just that the adjustments are plenty. Okay, given this particular information now, given the B, we can use the B to determine our depreciation. Or we can come to this particular place over here. The finance cost includes what? Foreign exchange loss of what? 23 million on retranslation of the foreign currency loan. So what is the finance cost here? What is the finance
66.
Cost? 66. Whatever be the case, we add all of them. Okay. Unless we have interest payable in the statement of financial position. If you don't have interest payable, you adjust the finance cost against the long-term loan. You adjust the finance cost against the what? The long-term loan. If you have interest payment as a different item, which is a liability, then you adjust the interest against the interest. Then you adjust the loan against the loan. But if you have only long-term loans and you have a finance cost, it is assumed that the instrument is accounted using financial instruments where the interest will be added to it, then we use subtract coupon. Are we okay? All right.
Please come again.
Okay. If you have only loan, we don't have interest payable. We only have loan in the statement of financial position. There is no interest payable. Then the loan is assumed to be what? To be accounted for using financial instruments where we have the fair value at the beginning, we add our finance cost, then we subtract our coupon payments.
Okay.
Okay, but if you have the interest payment, then you adjust your interest separately, and you also adjust your loan also what? Separately.
Oh, okay.
Okay. All right, so let's since we have the issue about the loan, that 33 million, there is no issue with the 33 million over there. So the 33 million is a loss. So we have added all the 66 already. Since it's a loss, it will be an expense. We have added all the 66 already. We don't have any issue over there. But let's adjust the long-term loan. Let's adjust the long-term loan. Okay, so the long-term loan. So let's look at the long-term loan. Okay, the long-term loan, what are we going to have? We start with the opening balance. Okay, the opening balance is what? What is the opening balance for the long-term loan?
98.
Okay, 98. Okay. Then what will happen? We add a finance cost, isn't it?
Okay.
Okay. The finance cost, you have to add all the 66 because they have already added what? The loss also to what? To the loan. Yes, the loss is even part of the loan balance there because it's a retranslation loss on the loan. So the retranslation will be added to the loan figure. So it's part of the closing balance over here. So the closing balance, which is 188, is calculated as the balance at the beginning. We add the loss, then we add the actual finance cost. So it means that the 33 is already part of the loss, or the 188 over here. So you add the loss, you add all of them. Okay. Because they added everything and they have gotten that particular figure. So what will be the supposed balance?
164.
164. Okay. 164. Is there any other issue on the loan? Okay. Let's see whether we have any other issue on the loan here. Okay. So there is no issue on the loan. And so the supposed balance is this. What is the actual balance?
188.
What is the difference?
24.
24. It means that there's an additional issue of what?
Loan,
which is what? 24 million. But if there's a reduction, it means that they have paid part of the loan. But if there's an increase, then it means that they have issued additional loan. Okay. Someone can also assume that, okay, the 66 over here, which is the interest, since 33, is it 23 or 33?
23.
Okay, since 23 is part of it, it means that they have actually paid 43 of the loan. Okay, if they have actually, someone can assume that the finance cost is 66, isn't it?
Yes.
Okay, included in it is a loss of 23. So the difference will be 43, isn't it?
Yeah.
So the person will say that they have actually paid this part of the interest. Okay, if they have actually paid this part of the interest, then this is what we are going to do. Okay, then we now have 98, which is the loan. But what will happen is that we only add the 23 to this one because this is a loss on the loan. This is a loss on the loan. So the loss will be added to the opening balance. Then we have the closing balance. Then this will now be, we are going to have 121 against 188. Let's find the difference.
$67.
Okay. You're having 67, isn't it?
Yes.
This will be inflow. You are issuing additional loan, isn't it? Okay.
Yes.
67 against amount that you paid. What will be the difference?
24.
24, isn't it?
Yeah.
Yes. So anyhow, the person, any assumption that you are using, since they didn't say they have paid the interest, you just treat the interest like that. So we have additional issue of loan, which is 24. So we go to financing activities. We have loan issue or issuance of new loan. Okay. Loan issue. That will give us 24 is inflow. So we are okay with that side. Then we go to the next.
Linus,
Yes, yeah.
Your Q has to come from the additional information. So once you take an additional information, that means something has to go into the cash flow, right?
Exactly.
Okay.
Exactly. Okay. So let's see whether, so we are done with the loan notes over there. We are done with the disposal. We are done with the acquisition. We are done with the process. Let's look at the D.
During the year acquired 70% shareholding in Iris Limited by paying 375 million, including 15 million for acquisition costs. The majority of this payment was financed through a rights issue of AL shareholders. The acquisition of AL resulted in goodwill of 45 million. The carrying value of AL's net assets as follows. On acquisition date, the fair value of AL's net assets was equal to their carrying value except for building, whose fair value exceeded the carrying value by 70 million. The building has a remaining useful life of 10 years.
Okay. Okay.
So with this, does it mean there's depreciation somewhere?
Yeah, the depreciation, you use this particular thing to now know the depreciation.
Then you go and add it to operating.
Yes, please. So we now look at how depreciation is to be determined. Okay. So we will be using this item now to now adjust what should have been the actual current asset balance, or what's supposed to be the current, the non-current or the PP closing balance, and what is the balance that they are giving to you. Is there any increase or decrease? Then you name it either depreciation or additional issue. But let's come to this particular place now. Okay, but we have to first tackle the amount that they are paying. During the year, PL acquired was 70% shareholding in by paying 375 million, including what? 15 million for what? Acquisition costs. Okay, the 15 million is part of what? The 15 million is part of what? Senior, the 15 million, is it part of the 375?
Yes, they say including.
Okay. Acquisition costs supposed not to be what? Capitalized. It's supposed not to be added to the investment. The only cost that can be added to the investment is the cost of issuing. No cost has to be added to the investment. But the only cost that will be capitalized, or the only cost that will be capitalized, is the cost of issuing your own shares. Okay, is the cost of issuing your own shares. So acquisition costs, professional fees, all those costs must be expensed as at when they are incurred. The only cost that must be capitalized is the cost of issuing your own shares. And this will be accounted for under financial instruments. If you are issuing shares and you incur issuing costs, what will you do? The shares will be treated as a liability. So if you are capitalizing that one, you subtract from your equity shares capital. So no cost associated with acquisition should be capitalized or should be added to the investment. Should be added to the investment. So the actual amount that they are paying for the assets is 360, not 375. The 15 of it is for acquisition cost, which is an expense. It will be expense, and they have done that already. The only cost that will be capitalized is the cost of issuing your own shares. That one, you will account for it as any transaction cost under financial instrument, where you'll be taking the cost from what? Your equity shares. That is how we go about it. Okay. So the actual consideration that you are paying is 360. Okay. The company is saying that they have what? The transaction resulted in a goodwill of what?
45.
Okay. What should have been the total net asset at acquisition? Okay, let me be using figures. What should have been the total net asset at acquisition? So let's look at how the goodwill is being calculated. Okay. The goodwill is calculated as purchase consideration of 360, isn't it? Okay. Then we add the NCI. We don't know the NCI. They have given you the goodwill figure for you to know the NCI at acquisition. Okay. Then we now have the net assets. What will be the total value of the net assets at acquisition? It will be 380 plus what? Plus the fair value of what? On the acquisition day, the fair value of the AL's net asset was equal to their carrying value, except for a building whose fair value exceeded the carrying value by 70. It means that the 70 is not part of what? The 380.
The 380.
Okay. So we added the 380 plus the 70. What are we having?
450.
45.
So we subtract this over here. Then we now have 45 as the goodwill, isn't it? Okay.
Yes.
How do you find the NCI now? How do you find the NCI at acquisition? So 450 plus 45 minus 360.
495 minus 360.
So I'm having 135 as the NCI.
495. 135.
Okay.
Yeah.
135.
Okay. So they are just giving you that particular information to know the NCI. Okay. So you now know the NCI at acquisition. You are also going to reconcile the NCI. We will go there. Okay. So that is it. Okay. But let's now look at, they are saying that majority of the purchase consideration was finalized through what? A right issue to PL's what? Shareholders. Let's go to the statement of financial position and see the changes in the equity items. What is the changes in the share capital?
Share capital, that's 50 plus 84.
Okay, 734 minus what?
Minus 650.
That is 84, isn't it?
Yeah.
Okay.
Yeah.
Were there any share premium at the beginning of the year?
No.
No. So the share
No.
premium, the assumption is that the right issue was done at a premium. So instead of them issuing the shares at 10 CD so that they can finalize the purchase, maybe they have done the right issue at 15 CD. But what will happen is that since the share capital is 10 CD, they will only recognize the 10 CD and send the remaining 5 Ghana cedis to what? Share premium, because they have issued the right issue. They have issued the shares at a value more than what? The 10 million. Okay. So you add your 121 to the 84, because they say the majority of the consideration was settled through what? Right issue. So 84 cannot be what? Cannot be the portion of the what? The right issue. So the right issue will be the 121 plus the 84. Okay, because there was no share premium at the beginning. So we assume that the share premium is coming as a result of what? The right
issue.
Yeah.
Okay.
So what will be the value there?
205.
Okay. 205. You see that this will be issue having what? They will issue this and have cash, isn't it?
Yes.
And this cash will still be used to purchase the what? The shares, isn't it? So this will now be having, we are going to be looking at this one in two ways. We are going to be looking at this one in two ways. Okay. One of them is that we assume that they have issued the shares, because this will come before they will use it to to pay for that one. So you see that they'll all be having what? A zero effect. It will be shown as investing activities as outflow, and it will be shown as financing activities as what? Inflow. Because we issue to the shareholder, we receive the money and we use the money to buy the subsidiary shares. So you can decide not to show them, or you can decide to show investment in subsidiary, which will be 205. Then you also look at right issue under financing activity as 205, which will be an inflow. But under investing, it will be an outflow. So should we show it, or we should just ignore it and focus on? Okay, let me just put the right issue over here. So we have the right issue of 205. So let's come to the total amount that we paid was how much?
375.
Okay, we have paid 375. You have to know that the 360 has already been taken from profit or loss. The 15, which is the acquisition cost, has already been expensed. It has already been expensed, so that one has been already taken care of. It has been subtracted from our profit. It has already been taken care of. So what will happen now over here is that we look at the investments in what? Investment in subsidiary. Okay, the investment in subsidiary. What will happen is that we are paying 360, but we are receiving a cash from them. Let's go to their net assets. What is the cash over there? What is the cash for them? Cash balance for them is what? At acquisition, what is the cash?
21.
Okay.
21.
So we are spending 360 and we are receiving 21. So we just net the cash balance from the amount that we are paying. That's how we do it. Okay. So you net the 21 over here. Then you now know your net amount that you are spending. So 360 minus 21. Okay. Someone can decide to show all the 360, then the person will go and add the 21 to the opening cash balance, because that will be added before they will get the closing balance. But subtract it over here to know your net amount that you are spending. So that will be 339. Okay, that is the net amount that you are spending. What do we do? Let's now reconcile our PP and with other items. Okay, let's reconcile our PP to know our. Okay, let's reconcile the goodwill first. Let's reconcile the goodwill first. Okay. What is the goodwill at the start?
136.
Okay. 136. So we have acquisition. Acquisition will bring a new goodwill. That will be 45, isn't it? Okay.
Yes.
So what will be the total?
One eight one.
Okay. 181. But what is the goodwill figure there?
118.
So it means that it has reduced by what?
63.
Okay. This 63 might be that the company has disposed of additional subsidiary, which they have lost control. So since they have disposed of that particular subsidiary, the goodwill of 63 will be going with the subsidiary. But if no disposal is done, the 63 will be seen as what?
Impairment.
Impairment of the goodwill. I've already looked at, they have disposed of subsidiary, but that particular one, it was a bargain purchase on the date of acquisition. So that is why I've calculated the impairment already, because there's a footnote over there. So impairment loss will be added because it was first subtracted. Okay.
So if the impairment was as a sale of a subsidiary, how is the treatment then?
Okay. So what you do is, what is the impairment? Okay, we have one. What is the opening balance that we have?
136.
136 plus 45, isn't it?
Yes.
Okay. Then you now bring disposal. The disposal over here is that this 136 is including the goodwill relating to the subsidiary that you have disposed. Then you bring the disposal over here. Maybe the disposal will be 25. Okay, so it means that since you are disposing it, the goodwill must also be removed from the what? The total goodwill. Then you now look for the actual goodwill compared with that one. And so that will now it will still be impairment, but you have to adjust the subsidiary that you are selling before, before you go about it. Okay.
Thank you.
Let's now take other one. We can now reconcile our PPE, or we can now reconcile all our asset items. So we can reconcile the PPE, we can reconcile the current assets, we can also reconcile the trade payables. Look at this one. Look at loan to associates. Loan to associates. Was there any loan for the associates at the beginning of the year?
No.
But for the current year, they have what? Given a loan to the associates. Okay, that is a cash item relating to this year. So that will also be seen as loan to associates. We have spent the cash of them. So loan to associates, you have to bring the 40 over here because we are giving this loan as a result of the investment. So this particular loan is given for this year. That is all about that. Let's now reconcile. We have reconciled the goodwill, equity instruments. Let's now reconcile the property, plant, and equipment, the current asset, and also the other current liabilities. Okay, let's reconcile them, and we'll move on. Let's reconcile the PPE first. Okay, so let's deal with the PPE. Okay, so the reconciliation, I can have PPE over here. I can have the current asset over here, and I'll have the other current liabilities. Okay, I'll do the reconciliation together for all of them. What is their opening balance? Balance brought down. Which is the 2022 balance.
PP 795.
Okay, 795. The current asset is what?
360.
360. Other current liabilities is what?
205.
205. Okay. So acquisition. We have bought additional PP, which is 153, isn't it?
Yeah.
Yes.
So we have dash here. There was a fair value adjustment, which will be added to the PP of 70, isn't it? Do you agree that there's a fair value adjustment?
Yes.
If we are consolidating, we'll be adding the subsidiary figure with the parent one. That is how come they will be getting the closing balance. Okay, so we just want to work how the closing balance was gotten.
Okay.
So what will happen now is that there was a disposal, isn't it?
Yes.
And that disposal was 56. It will be taken away. Then we have dash. Okay. There is also acquisition of a subsidiary, which the asset will be added to these particular items now. So let's go to the subsidiaries figures. They are assets at acquisition. So we have 265, 152, and 58. So 265. 265 for the parent, it will be added. And we have 58 over here. The current asset is what? I've forgotten.
152. Okay,
152. Okay. There was a disposal of a subsidiary. So up to this side, we are almost done with this particular side now. This particular footnote. We are done with this particular footnote because this one we just needed to do the adjustment. So we have done a good job. We have the NCI. We have the goodwill. We have done the adjustment over there. Let's come here. During the year, the company disposed a subsidiary of this particular amount. Okay. So there's something that we have to take into consideration. Yeah, I read the E.
During the year, PR disposed of its entire shareholding in Global Limited for a consideration of direct fund, out of which 65 million remains receivable at year end. The shareholding in VL, acquired many years ago for 140 million, has resulted in a bargain purchase of 40 million. On the date of disposal, VL now controls interest amounted to 150 million cedis. The carrying value of VL's net assets, excluding cash balance at the time of disposal, were as follows.
Okay.
PP,
So you can see that the acquisition of the PL, the acquisition of the VL was resulted in a bargain purchase. That's why we didn't subtract the goodwill from the total goodwill before we know the impairment. So it can result in a goodwill. So you have to take the goodwill. Since they are selling now, it means that their asset and everything will be removed because we now transfer the asset, the liability and everything to the new buyers now. We don't have control over them. So we can't consolidate them again. Okay. But this has resulted in what? In a bargain purchase. So that has been recognized as a gain in retained earnings. We don't have to do anything about it. But what was the total consideration what was the total amount what was the total amount? The total consideration was how much?
300.
Okay, it is 300. But what is the portion that we have received in cash?
$365. 235.
Okay, so we have received a cash from the disposal. That will be, this is through what? Investing. So we do proceeds from the disposal of the subsidiary. Proceeds from the disposal of the subsidiary. That cash is received during the year, which will be 335. We are going to be doing something to this 335.
No, 235.
Okay, 235. We will come and do something to this 235 again, but I will come there after we have determined whatever balance that we have to determine. Okay, let's now come here. Okay, let's now come here. We look at what? There will be a receivables over here. So you see that the closing receivables that we have over the 65 will be part of it. Do you agree? We are here to receive the 65 from those people. So the 65 is part of the closing balance there.
Okay.
But they have consolidated everything already. They have done the writing, but we are just coming to look at how the writing should be done. And if we should do the writing ourselves, what should be the figures? Then we just look at the movements. That is all. Okay. There will be a disposal of the subsidiary, and the asset will be going. So the asset, 300 of it will be taken away from PPE because we'll be transferring 300 of the PPE to those people. 120 of the other current
assets
will be going, and 80 of the receivable, the
payable
will also be going. Okay, let's now total it and look at let's get a supposed balance, and so 795 plus 153 plus 70 plus 265 minus 356. I'm having 927.
Confirmed.
Okay. 360 plus 152 plus 65 minus 120. I'm having 457. $205 plus 58 minus 80. I'm having 183. Can someone confirm them?
Yes.
Okay, let's look at their actual balance, their closing balances reported. PP is what?
814.
814. What is the difference?
$113.
And that 113 is what?
Disposal.
Depreciation.
Depreciation.
Yeah,
okay.
based on our calculation, it's supposed to be 927. But they are reporting 814. So it means that it has reduced. So the depreciation charge for the year is the 113.
Okay.
Okay. But sometimes they can give you this 113 and they'll be expecting you to calculate the acquisition of the 153. Okay. But sometimes they can also give you a depreciation. You just have to reconcile the item. That is the basic thing about it. It's not difficult.
Okay.
So we now have a depreciation of 113, which is supposed to be added. So we now go to our other issues now. Okay. Our other issues now. Okay. So we are done with the disposal now. We have to reconcile our NCI. We have to reconcile our NCI now. So let's look at
what happens to
the current assets and the current liabilities.
Okay. I haven't done a reconciliation for them. So let's look at them. Sorry. That will be the change in the working capital items. Sorry.
Working capital items.
Okay. The actual for current asset is what?
Current asset.
489.
489. Okay. So we should be having 457, isn't it?
Yes.
And they are having 489. Okay. So what is the difference there?
32.
Okay, that 32 represents what?
Increase in current assets.
Okay. So it means that they are having 489.
Out.
So you just assume that this is the opening balance, but your closing balance is this one. The closing balance of the current asset will always increase your cash receipts because the revenue that is used over there is sales. How do we calculate the sales? We prepare the debtors ledger control accounts or sales ledger control account or total debtors control accounts, where we subtract the opening balance from the cash receipts and we add the closing balance to have our total sales. So the meaning is that 32 over here has been added to the cash already, which have overstated our cash. So let's go and subtract it. That is the change over there. So you look at the change in working capital items. Working capital items. So you look at increase in receivables or increase in current assets. So that will be, it's 32M.
Yes.
Okay, let's come to our payables too. What is the
um 144.
Okay.
144.
Closing balance was 144.
Yeah.
Okay. So what is the difference?
39.
39.
9.
So that 39 will be an outflow if the opening balance of a payables is higher. It means that it will be subtracted from, it will be added to our purchases. It will be added to the purchases, then no, it will be subtracted from the cash that we paid. Then we add what? The closing balance. So we have subtracted more than we should subtract. So we have subtracted 39 in excess. So we have to go and also subtract that particular 39. Okay. So our cash receipt, our cash paid has reduced more than. So that will be a decrease in the payables. So it means that the opening balance of the payables will be taking, the difference is what?
39.
39. So it means that this particular, our cash receipt, our cash paid has reduced by 39. Has reduced by 39. Okay, if it has reduced by 39, it is going to be increasing our cash receipt. So let's go and remove that 39 over there. That is the meaning. Okay, we have looked at this thing the last time. I don't have to talk much. So that is for that particular one. We have done the reconciliation for the current asset and other cash balances, the trade payables. We have done that one already. Let's come to the non-controlling interest before we tackle the F. So let's come to the non-controlling interest. We have to reconcile the non-controlling interest. So let's reconcile the non-controlling interest. What is the opening balance?
268.
266.
268.
Okay. What is the non-controlling interest from the new acquisition?
We calculated it somewhere.
Yeah, 135.
Yeah.
Okay. So you can see that there's a disposal. So the closing balance for the non-controlling interest is calculated by adding the new non-controlling interest from the new acquisition. We add it. There's a disposal somewhere. And since we are disposing, it means that the non-controlling interest will also be going. We don't own the company again, and there will not be any issue amounting to non-controlling interest. On the date of disposal, the non-controlling interest amounted to what? 150. Amounted to what? 150. So we supply the 150 over here and know the actual non-controlling interest, the supposed non-controlling interest. 268 plus 135 minus 150. I'm getting 253. Is that correct?
Yes.
Okay, let's now look at the non-controlling interest at the reporting date. Okay, sorry, there will be a share of the profit. Profit attributable to the non-controlling interest. 81 will come there, sorry.
81.
Yeah. So the share of the profit will come. Okay. So share of profit will come. So that will be 81. So let's find the total amount now. Plus 81.
334.
334. So let's now look at the amount reported in the statement of financial position.
291.
291. Okay. 291. What is the difference?
Is
it an increase or decrease?
Decrease.
Okay. So that particular decrease will be the dividend paid to the NCI. They have paid a dividend to the NCI. NCI is accounted for. So the dividend paid to the NCI. The dividend paid to the NCI. That will be 43. Okay. So we have reconciled the NCI. Let's now reconcile, or let's take the last footnote. Then we now come to the equity items. We reconcile them, especially the equity items. We have reconciled the share capital and the share premium already. So we come to the retained earnings. The retained earnings, there will be a portion of dividend paid to the parent equity shareholders there. Okay.
So please, why did you record the 43?
The 43 is under financing activities. Okay.
Profit from discontinued operation, as reported in the statement of profit and loss, comprises of VL's operating loss amounting to 42 million, and a gain on disposal of VL amounting to 75 million.
Okay. So it means that there was a loss from the discontinued operation of 42 million. They have now net this particular amount against the 75 million on this particular figure. Okay, the question is, how do we calculate a gain on disposal of a subsidiary? How do we calculate a gain? We take the amount that we are receiving, then we take the portion of the parent net asset from it. Okay, so the proceeds that we are receiving is how much? From the sales, it was 300, isn't it?
Yes.
Okay. What we do is that we add the NCI, isn't it? We add the
150.
150. What do we do now? We take the net asset from it.
340.
340. Okay. So this is supposed to be 450, isn't it? if you add the 300 and that one is supposed to be 450, isn't it?
Yes.
But our net asset is what? 340. What's supposed to be the actual gain?
110.
But they are saying that the gain is what?
75.
What is the difference?
So 25, 35.
35, isn't it?
Yeah.
The 35 is cash. You can see that they say the net assets, the carrying value of the VS net assets, excluding what? Cash balances. So it means that the net assets, if cash is included, supposed to be 375. So you have to determine the cash that will be lost at the date of the disposal. But sometimes the question can give it to you. So the actual gain that you should be getting should be 110. But they are now telling that the gain is 75. It means that there's a portion of the net asset that is hidden, which is 35. And that one is excluding the cash balances over there. So you are receiving 235 and you'll be giving out what? 35. It means that this 35 will be taken from the proceeds that you are receiving from the sale. I'll put a sale over here. Proceeds from disposal. We take the 35 from it. Because we are selling for 235, but we'll be losing what? 35 of the cash. So that will be taken away from that particular figure. I'm sure. Let's now reconcile the retained earnings. Then we put them together. Let's reconcile the retained earnings. Then we put them together. So the retained earnings, we are reconciling to know the dividend that the dividend that was paid to the parents holding. Let's look at the opening balance. What is the opening balance for retained earnings?
$265.
Okay. Okay, the opening balance is 265. Okay. 265. Okay, what is going to increase the retained earnings?
Profit for the year.
Okay, so let's look at the parent share of the profit. It will be only the parent share of the profit. This is group retained earnings. What is the parent share of the profit?
241.
241. Okay. So what's supposed to be there? What? The supposed balance supposed to be what?
506.
Okay, 506. But what was the balance given?
370.
370.
370. What is the difference?
30.
135. 136.
136.
So the 136 is the dividend paid. So the parent has paid the dividend of this one. So that is the dividend paid to the parent company. So dividend paid. You show them one by one. Dividend paid to the NCI will also be shown. So you look at the parent company. So that will be 136. So the cash flow is just the reconciliation. We are done. So you just put them together. So we have 7-1 over here. So let's you can put them together and see. So you have 66 plus 11 plus 63 plus 113 minus 81 minus 71. So I'm having positive 1010
101
plus 289. I'm having 390.
390.
Okay. So this will give us 200 as cash flow. Okay. So you now have 200 plus 45 plus 44 minus 100 minus 153 minus 339 minus 40. Okay. 100.
Negative 343.
Negative 3.
43.
Okay. Okay, 343. So that will be a negative. Let's come to investing activities. What are we having? 24 plus 205 minus 43 minus 136. 50.
50, yeah.
Okay. So 50 plus 390 minus 343.
Hello, Linus.
Yes, yeah.
The dividend paid, can it be recorded under investing activities alternatively?
The dividends, is it the one paid to the owners?
Yes.
No, the one paid to the owners, we are receiving money from them. So they are financing activities.
Okay.
Yeah.
Okay. All right. Thank you.
Okay. So the net cash flow for the year is 97, isn't it?
Yes, please.
So let's add the opening balance.
That's 172.
Yeah, it's supposed to be 142. So maybe dividend paid. There's a dividends issue here. Sorry. You can see we have dividend payable here, isn't it?
Yeah, and yeah.
Yeah, so it means
Yes.
that the dividend declared is supposed to be 143. Okay. The dividend that we recorded is 143, isn't it? Okay. So the
So different 4, different 12.
okay. Okay.
What did you get for operating?
Operating, I got 390. So the dividend paid will be dividend received 45. Okay, let's count here. The dividends. Okay, dividend received is this one. The dividend paid is 136. Okay, 136. So this 136, what we do now is we are going to be having 16. So we add. So the actual dividend that was paid will be 4 plus 136. So the total figure that we should be having should be 4 plus 136. 140, then minus 16. So the dividend is supposed to be 124. Okay. So we are going to be having, so the dividends will be 124.
So let's use the balances and see.
Okay, 124.
Linus.
Yes, yeah.
Yeah, please, the dividend, add it to the worksheets. How you came about with the 124. So the balance has started, the balance has closed, so that when we are revising at least.
So the dividends will be balance roll down, which will be 4. Dividend declared. Dividend declared. Okay. The dividend declared. Let's put the total dividend together.
Okay.
Okay, even if you put all of them together, you still be having the same thing. So let's just adjust it again, this one. This
Okay.
is 140. So we have the closing balance is 16. So it means that they have paid 124. Okay.
Okay.
So the 124, we have 24 plus that one minus 43 minus 124. So I'll be having 62 here. So 62 plus 390 minus 343. I'm having 109 plus 97. 206 minus 140. That's a difference of 64.
The 64.
That's why you're adding the 97.
97 is not the opening balance.
The opening balance is 75.
It's 75. Opening balance is 75. Okay.
Yes, please.
So 64. No, it's supposed to be. Let's what will now be the new balance now? It will be 97 plus 12. That would be 109 plus 75.
Exactly.
Okay, plus the opening balance of 75, isn't it?
Yeah.
75. Then we have minus 142.
I'm getting 42.
There's a difference of 42. So this 42 must be as a result of the some of the
Linus, please, the working capital items.
okay.
The receivables from the disposal of the subsidiary, do you add it?
Let me see. I have
Okay,
taken
okay, it's there.
I've taken the 120.
It's there, 65.
Yeah.